Most organizations still treat VAT like a monthly paperwork ritual, but you're not running paper anymore.
You're running APIs, marketplaces, automated billing, and instant settlement, and you're trying to bolt a paper-era tax control system onto that. ViDA is the EU admitting the obvious: VAT has to operate at transaction speed. In this video, you'll learn what actually changed, why we'll buy an e-invoicing connector later fails, and how this lands in Dynamics 365 Finance and Power Platform architecture. There's one program killer mistake coming up. Don't make it. The foundational misunderstanding. ViDA is not compliance. It's a control plane shift. The foundational misunderstanding is that ViDA is a compliance project. It is not. Compliance is what people say when they want the work to stay in tax and finance, with IT supporting later. ViDA doesn't support that fantasy because it moves VAT from periodic reporting to continuous transaction controls. That distinction matters because your architecture either produces compliant transactions by design or it produces exceptions at scale. Historically, VAT ran on delay. You issued invoices when you got around to it, you reported in returns on a monthly or quarterly rhythm, and you fixed the mess at month end. That delay wasn't a convenience. It was a fraud surface area and an error buffer. The longer the gap between the transaction and the authority seeing it, the more room there is for missing invoices, mismatched listings, and creative interpretations that only get challenged months later. ViDA compresses that gap. For Intra-EU B2B supplies, the direction in the research is simple: structured e-invoices, issued within 10 days, with digital reporting that happens near real time. And the purchaser side also reports, with a few extra days. That's not an upgrade to the VAT return. That's a new operating model where every invoice becomes an event that must be correct when it happens. Now here's where most programs fail. They treat e-invoicing like a document format change. They think this is, we used to email PDFs, now we send XML. So they go shopping for a connector or a middleware plugin, and they push the problem to the edge of the ERP. That is how you build a brittle point solution that collapses the first time a validation rule rejects an invoice. Because e-invoicing isn't the hard part. The hard part is that invoicing sits at the junction of ERP posting, tax determination, customer master data, product classification, credit note discipline, payment terms, and audit retention. ViDA doesn't just inspect the invoice, it inspects the system behavior that produced it. In architectural terms, ViDA behaves like a control plane, a layer that enforces constraints on the data plane. Your transaction systems, Dynamics 365 Finance, your e-commerce stack, your procurement platform, are the data plane. They create economic events: supply, invoice, payment, correction. ViDA introduces a control plane that requires those events to be expressed in a standardized semantic model, transmitted in constrained time windows, and reconcilable across parties. The control plane doesn't care about your org chart. It cares about determinism. Most organizations run VAT as a probabilistic model. It's usually right and will fix the outliers later. That works when the authority only sees aggregated totals weeks or months after the fact. ViDA pushes you toward a deterministic model. Each transaction must be right enough to survive validation, matching, and audit without manual cleanup as a dependency. And the thing most people miss is what creates probabilistic VAT at scale: exceptions. Every exception you tolerate becomes an entropy generator. We'll allow missing VAT IDs and fix later. We'll allow free text tax codes. We'll let credit notes reference whatever. Each one feels operationally flexible. Collectively, they turn your compliance posture into conditional chaos. Under ViDA's timelines, that chaos doesn't just exist, it becomes visible immediately. So what does control plane shift mean for Microsoft ecosystem architecture? It means Dynamics 365 Finance is no longer just your accounting truth. It becomes the source of regulated events. The posting and tax determination outcome must be final grade because there's no comfortable buffer between posting and reporting. You can't post sloppy and export clean later. The system did what you configured it to do. And the authority will see it. It means Power Platform stops being nice to have automation. Power Automate becomes the routing fabric for exceptions and corrections because humans will still resolve issues, but they must resolve them inside a governed lifecycle. Triage, remediate, resubmit, and preserve evidence. And Power BI becomes the visibility layer that tells you daily whether you are drifting into non-compliance through exception accumulation. And it means integration design is no longer about getting data from A to B. It becomes about chain of custody, generating an immutable payload, capturing acknowledgements, and making the reconciliation provable later. The open loop mistake, the one that kills programs, is treating ViDA as a bolt-on and discovering late that your ERP data model can't actually produce what the e-invoice standard requires. Or worse, it can, but only if someone fixes it in Excel before submission. That is not a process, that is a future audit finding. This is the uncomfortable truth. ViDA rewards architecture and punishes patchwork. Once you accept it's a control plane shift, the rest becomes straightforward. Not easy, straightforward. And that's why the next thing to understand is how the three pillars behave like one system, not three work streams. ViDA's 3 pillars as one system, not 3 work streams. Most organizations read ViDA as 3 separate work streams: digital reporting and e-invoicing, platform rules, and single VAT registration. That framing is comforting. It's also wrong. Architecturally, those pillars behave like one system because they all touch the same invariant. You must be able to calculate VAT correctly, express the transaction in a standardized way, transmit it inside the deadline, and prove later that what you reported matches what you settled. Different obligations, same pipeline. Pillar 1 is the obvious one: structured e-invoicing and near real-time digital reporting for intra-EU B2B, with the supplier issuing within 10 days and the buyer reporting shortly after. That's the part everyone notices because it's loud. It forces invoice semantics, formatting discipline, timestamps, and acknowledgements. But Pillar 1 alone doesn't close the loop, because reporting isn't the same thing as settling, and settling isn't the same thing as filing, and filing isn't the same thing as proving. Under ViDA, those gaps stop being operational trivia and start being inspectable behavior. Pillar 3, single VAT registration through OSS expansion and reverse charge expansion, looks like simplification, and operationally it is. Fewer local registrations, fewer local returns, fewer local portals, but it also centralizes your truth. If you report output VAT through OSS, you still need transaction evidence that ties to what you declared. If reverse charge applies, the invoice treatment depends on customer status and establishment logic, and that must be correct at transaction time. So Pillar 3 changes where you file. It doesn't remove the requirement to be right. And Pillar 2, platform deemed supplier for short-term accommodation and passenger transport, looks like a niche pillar until you run any platform-like model internally. Marketplaces, intermediated services, we collect and remit on behalf of arrangements. ViDA drags those commercial models into the VAT control surface by moving liability to the platform under conditions described in the research. If the underlying supplier isn't obliged to pay VAT or doesn't provide a VAT number, the platform becomes responsible for charging and remitting. That means the platform must also capture evidence and make decisions, and keep those decisions linkable to the transaction record. Now connect the dots. A deemed supply still produces invoices. It still flows into digital reporting where applicable. It still has to reconcile to payouts and refunds. So Pillar 2 feeds Pillar 1 and Pillar 3, whether you like it or not. This is the system behavior ViDA is pushing: calculate, report, settle, file, prove. Every one of those verbs maps to a technical artifact in your stack. Calculate, tax determination logic, and master data quality inside Dynamics 365 Finance and whatever front-end order systems you run. Report, the regulated payload, E-Invoicing 931 semantics for the invoice data model, and the digital reporting submission with identifiers and timestamps. Settle, payment reality, PSP payouts, net fees, chargebacks, refunds. Because VAT exists in gross amounts, but your bank sees net settlement. File, the VAT return world doesn't disappear overnight. OSS returns and remaining local filings still exist, just with more upstream constraint. Prove, evidence packs, payloads, acknowledgements, VAT ID checks, location proofs, FX source, correction trails, not as a documentation project, as a system output. Most failures happen because teams build only the report component. They ship an e-invoicing integration and call it done. But the first audit question under this model is predictable. Show that the invoice you reported matches the posted transaction, and show that the VAT you reported matches what you collected and remitted. If you can't answer that with a query and an evidence bundle, you don't have compliance. You have hope. This is why the Microsoft positioning matters, and it's not marketing. Dynamics 365 Finance is the system of record: posting, tax outcome, invoice lifecycle, corrections. Power Platform is the system of orchestration and insight. Exception routing and resubmission flows in Power Automate, and daily compliance health in Power BI. Azure is the system of scale and resilience: message durability, storage immutability, integration patterns that survive outages. Kept implicit because the point isn't cloud purity, the point is chain of custody. Once you see the pillars as one system, the timeline stops feeling like we have until 2003, because you don't implement this in 2029. You implement the pipeline, then you expand coverage. And that brings us to the timeline reality: phased law, continuous engineering. The timeline reality: phased law, continuous engineering. The next comfortable assumption is that ViDA is a 203 problem. It is not. The law lands in phases, but your engineering doesn't. Because the hard part isn't flipping a switch in July 2003. The hard part is building a transaction-grade pipeline that survives 5 years of drift, partial adoption, and country-by-country reality. Here's what the research actually gives you on timing, in plain terms. First, the political process is effectively done. One of the research sources frames it as political agreement in autumn 2024, with adoption by the EU Council in March 2025. And in the webinar transcript, the speakers described the package as entered into force as of April 2025, with member states already able to introduce certain e-invoicing rules without the prior approval step. So even if your organization wants to treat this as a future project, member states are free to treat it as a present lever. Second, the package is phased. The webinar frames a multi-year path with a completion horizon out to 2035, and it calls out July 2028 as the first tranche for the single VAT registration pillar. Then July 2003 shows up as the point where Intra-EU e-invoicing and digital reporting become mandatory. That's the headline date everyone repeats because it's clean. But you don't build clean systems against clean dates. You build against messy change windows. And there's one detail from the webinar that matters architecturally in new systems versus old systems. The webinar describes new systems as domestic e-invoicing and reporting regimes introduced after 2024 that didn't rely on the older EU derogation pattern. Those new systems must harmonize by 203. The old systems, the legacy clearance-style regimes that already had derogations, have a longer harmonization window out to 2035. That distinction matters because it guarantees heterogeneity during your build window. From an architecture perspective, that means you won't get one uniform reporting rail in 2027 or 2028 or even 203. You'll get a mix: interoperability patterns in some places, clearance patterns in others, plus country-specific implementation choices that still meet the EU's direction but not your desire for simplicity. So what moves first inside enterprises, not the connectors? The data model. If your invoice data in Dynamics 365 Finance can't deterministically produce the fields and codes that your e-invoicing and reporting rail expects, every downstream component becomes an expensive bandage. And because ViDA compresses timelines, issue within 10 days, report near real time, you don't have a month-end remediation window to hide behind. The second thing that moves first is your integration pattern. Most teams start by asking, which provider do we pick? That's procurement, not architecture. The architectural question is, how do you emit an immutable transaction payload with stable identifiers and capture acknowledgements so you can prove what happened later? That means event thinking: invoice posted, payload generated, submission attempted, response received, correction linked. If you can't represent that lifecycle, you can't govern it. And if you can't govern it, you can't scale it. The third thing that moves first is the exception lifecycle, because the reality of phased adoption is that you'll spend years living in partial coverage. Some flows on structured invoices, some on PDFs, some on domestic mandates, some on intra-EU mandates, some on reverse charge expansion, some on OSS strategy shifts. In that world, exceptions aren't occasional, they're structural. If you don't productize exception handling early, triage, remediation, resubmission, evidence capture, you'll drown in manual effort exactly when the deadlines get shorter. And here's the part people don't like hearing. 203 is far away is fantasy because your organization's lead time isn't the law's lead time. You need budgets, you need master data cleanup, you need testing cycles with external rails, you need operational ownership, you need controls that work when people are tired and the provider is down and the quarter end is on fire. The system doesn't care that the regulation is phased. The system only cares whether you engineered a pipeline that can absorb change without generating permanent exception debt. So treat the timeline as an engineering runway, not a compliance calendar. Phase 1 is building the rails. Canonical invoice data, regulated payload generation, submission and acknowledgement capture, and dashboards that make drift visible. Phase 2 is scaling coverage. More countries, more transaction types, more workflows. Phase 3 is resilience. Replay, idempotency, lawful degraded modes, and evidence packs that survive audits. That's the only way to meet a phased law with continuous engineering. And once you accept that, Pillar 1 stops being e-invoicing. It becomes a set of system requirements you can actually build against. Pillar 1 in one sentence: every invoice becomes a regulated data packer. Pillar 1 sounds like mandatory e-invoicing and digital reporting. That's the headline. In system terms, it's simpler and harsher. Every invoice becomes a regulated data packet with a deadline, a schema, and a delivery receipt. In the current state, an invoice is a document, a PDF, an email attachment, sometimes paper, sometimes downloaded from the portal. The research calls this out plainly. The form has been fairly free. And the reporting model matched that freedom. VAT returns, EU sales listings, periodic declarations, and cleanup time to reconcile what actually happened. ViDA flips the direction of travel. For intra-EU B2B supplies, the research describes the future state as a structured, machine-readable e-invoice issued within 10 days of the chargeable event, with invoice data transmitted digitally to the tax authority near real time. The purchaser reports too with additional days, and the reporting is per invoice per transaction. Summary invoices survive, but only inside a narrow monthly window with the same issuance deadline discipline. That shift matters because invoice stops being the final artifact and starts being the carrier for regulated data. It's not a file you send. It's a payload that has to pass validation, preserve identifiers, and remain linkable to downstream reporting, corrections, and audit evidence. Now here's where most people mess up. They assume the only problem is outbound formatting. So they build a PDF to XML converter mentality, or they pick an integration partner and assume the provider will handle compliance. Providers can handle transport, sometimes validation rules, sometimes country adapters. They can't manufacture truth. If the posted transaction in Dynamics 365 Finance doesn't contain the right semantic content, correct VAT IDs, correct addresses, correct classification, correct totals, correct sequencing, your regulated packet is wrong before it ever leaves your tenant. And once you're operating under a 10-day clock, wrong packets don't wait politely until month end. They come back as rejections and exceptions while the business keeps selling. This is what Pillar 1 really imposes on architecture. First, time discipline becomes a system property. You can't rely on someone runs invoicing on Fridays or we batch post at month end. If the invoice must be issued within a defined window, your posting to invoice to submission flow has to run as a pipeline, not a periodic task. If your process design requires humans to do manual pre-checks to avoid rejection, you've already failed at scale. Humans don't scale, queues do. Second, structure becomes mandatory. A structured e-invoice isn't a nicer PDF. It's a set of fields, codes, and totals that machines can parse and compare. That means your invoice is now a compiled object. Think of EN6931 as the bytecode spec. If your data doesn't compile, it doesn't execute. The authority doesn't read your intent. It validates your output. Third, acknowledgement becomes part of accounting reality. In a clearance-style world, an invoice might not be real until it's accepted. In an interoperability world, you still end up with delivery and status signals. Either way, you now have an external state machine attached to your invoice lifecycle. Submitted, accepted, rejected, corrected, resubmitted. If your ERP treats invoicing as a one-way print action, you'll bolt on status tracking later and wonder why nobody trusts the numbers. So what should a Microsoft-centric organization internalize? Dynamics 365. Finance has to produce a canonical invoice record that's stable enough to map to the regulated packet without interpretation layers. The tax determination outcome has to be final grade at posting time because you won't have enough time or enough people to massage invoices into shape before submission. Power Platform is where you keep your sanity. Power Automate is how you route rejections to owners, enforce remediation steps, and preserve the correction trail without inventing side spreadsheets. It becomes the control fabric that keeps exception handling deterministic. Who touched what, when, why, and what got resubmitted. And Power BI is how you stop lying to yourself. Not with one big compliance dashboard that nobody opens, with a few ugly metrics that force reality into view: submission success rate, rejection categories, exception aging, and time to issue compliance. If those metrics drift, your system is decaying, quietly, daily. The thing to remember is that Pillar 1 doesn't just digitize invoices, it makes invoice production observable. That's the real enforcement mechanism. When both supplier and purchaser report transaction-level data inside tight windows, mismatches stop being abstract. They become detectable behavior. And once behavior is detectable, it becomes governable by the authorities and by your own control functions, whether you planned for that or not. So yes, every invoice becomes a regulated data packet. And the next problem isn't transport, it's the semantic contract you don't get to renegotiate. N16931 as the semantic contract. N16931 is where ViDA stops being a policy conversation and becomes an engineering constraint. Because EN16931 isn't a format, it's a semantic model. What an invoice means, expressed in structured data, in a way that other systems can validate and compare. The research is explicit on this point. Syntax can vary. UBL or UNCFACT CII show up a lot, but the semantics must hold. That distinction matters because you can swap transport rails and message wrappers all day and still fail compliance if your invoice meaning doesn't compile. Most enterprises hear EN16931 and assume it's just another mapping exercise. It isn't. It's a contract you don't get to renegotiate because the whole purpose is interoperability across member states and across trading partners. Under a periodic VAT return model, your internal invoice could be messy and you could still file totals that mostly reconciled. Under a transaction reporting model, the invoice itself becomes the tax fact, and EN16931 defines the tax fact shape. Here's the uncomfortable truth. Your ERP invoice is not the invoice anymore. Your ERP invoice is a source record. The E-invoice is the regulated representation. If you treat those as the same object, you'll build fragile transformations that drift over time. If you treat them as separate, you can enforce a canonical mapping layer. This field in Dynamics 365 Finance maps to that semantic element under these conditions with these controlled code lists. Now here's where most people mess up. They focus on, can we generate UBL, and ignore validation behavior. Because the rail doesn't care if your XML is pretty. It cares if the data is complete, consistent, correctly coded, and mathematically coherent. The research source on EN16931 calls out a reality that catches teams off guard. There are hundreds of data fields, and many are conditional. That means optional doesn't mean ignore. Optional often means required when a business condition applies, which is how systems generate silent failure. The field exists, but the rule that should populate it doesn't. So when does this become a Microsoft architecture problem? Immediately. Dynamics 365. Finance can post invoices with incomplete customer records, loosely governed addresses, or inconsistent tax code usage, because historically humans could fix it later. Under EN 16931, semantics, those shortcuts become rejection categories. And once rejections exist, you've created a parallel process. Fix, resubmit, and preserve evidence. That's where entropy accelerates. The thing most people miss is that semantics beat transport. You can buy a PEPL access point. You can buy a clearance gateway. You can buy a compliance provider. None of that fixes the underlying semantic debt. If your VAT IDs aren't consistently captured, if your invoice numbering discipline drifts, if your credit notes don't link cleanly to originals, you'll spend your budget on integration and still fail on meaning. And yes, EN 16931 forces discipline in areas enterprises have historically treated as negotiable. Conditional fields that depend on scenario. Code lists that require controlled values instead of free text. VAT identifiers that must exist and be correct at the moment of issue. Sequential numbering and traceability that stop being an accounting preference and become a regulated expectation. So what do you do with that in a D365 Finance plus Power Platform world? You treat the mapping to EN 16931 as a first-class artifact, not a spreadsheet that lives with the consultant. A governed model, versioned, tested, and tied to release management. Because your business will change, your products change, your pricing models change, your master data changes, and every change threatens the semantic contract unless you enforce it by design. Power Platform becomes the enforcement surface. Power Automate can route missing data exceptions before invoice issuance, not after rejection. It can enforce approvals when conditional fields require human confirmation. It can attach evidence, VAT ID checks, decision logs, correction reasons directly to the transaction context instead of scattering it across email threads. And Power BI becomes your semantic drift detector. Not how many invoices did we send, but which semantic requirements are failing, which customers generate the most rejections, and how long do we sit on exceptions before the deadline window closes. One more detail from the research is worth stating plainly. Deviation is only tolerated if interoperability remains guaranteed. That means you can keep internal extensions, but you must still be able to produce the standardized representation that other systems can accept. In architectural terms, extensions are allowed, but they're contained. So if you remember nothing else from this section, remember this. EN 16931 is the invoice schema of record for cross-border regulated reporting. Your job is to make your systems capable of emitting it deterministically, not heroically. Because once invoice semantics are standardized, the next unavoidable decision is the rail. Interoperability or clearance. Interoperability versus clearance, the rail choice you can't avoid. Once EN 16931 becomes your semantic contract, you hit the next reality wall. The rail. Not which vendor, the rail model. Interoperability or clearance. Most organizations try to postpone this choice by pretending they can build one integration and adapt later. That's comforting. It also guarantees rework because these rails don't just change message routing, they change process behavior. When an invoice is considered issued, what acknowledgements exist, how sequencing is enforced, and how exceptions are operationalized. Interoperability is the PEPL-shaped world. You exchange structured invoices between parties through access points. The rail behaves like a network. You send, they receive, and the system's job is delivery plus baseline validation. It scales because it's not one country's portal. It's a federated model you can reuse across partners and in practice across jurisdictions that accept the same interoperability approach. Clearance is the Italy SDI archetype. The invoice goes through a central or quasi-central node that validates and often acknowledges before it's considered acceptable. It behaves less like email and more like a gate. You don't just transmit, you submit. And the system gives you a deterministic response that becomes part of the legal lifecycle. That distinction matters. Because in interoperability, your biggest failure mode is mismatch. Invoices get delivered, but don't reconcile cleanly with what gets reported or settled. In clearance, your biggest failure mode is blockage. Invoices can't proceed until they pass validation, which means operational downtime turns into revenue friction. Now here's where most people mess up. They assume interoperability is easy and clearance is hard. In reality, both are hard. They're hard in different places. Interoperability shifts pain into consistency and reconciliation. If you can send invoices, you can generate volume. Volume exposes semantic drift. Drift creates disputes. Disputes create correction traffic. Correction traffic becomes exception debt unless you engineered the lifecycle. Clearance shifts pain into determinism and sequencing. You have to get invoice numbering discipline, credit note linkage, and payload validity right the first time because the rail is designed to reject. It's not being rude. It's enforcing the control plane. ViDA's goal, according to the research, is to reduce fragmentation, but it does not magically erase member state choices. You will live in a mixed world. Some countries leaning into interoperability patterns, others maintaining or evolving clearance patterns, and some adding domestic requirements on top. Harmonization windows exist, but that doesn't make your operating reality uniform. So what should you build? Not a country-by-country spaghetti bowl of adapters bolted directly onto Dynamics 365 Finance. You build a provider mesh with a normalization layer. In other words, one canonical invoice object inside your architecture mapped from D365 Finance, then transformed into the required syntax and pushed onto the required rail with consistent identifiers and consistent evidence capture. Because the real product isn't we can send UBL. The real product is every invoice has a chain of custody that survives transport differences. That means your normalization layer must do a few unglamorous things reliably. 1. Stable identity. A posted invoice in Dynamics needs a durable identifier that follows it through payload generation, submission, acknowledgements, and corrections. If you let each rail invent its own keys, you've already lost reconciliation. 2. Status as a first-class state machine. Submitted, accepted, rejected, corrected, resubmitted. Those are not technical statuses. Those are finance statuses now, because they determine whether your reported data matches reality. 3. Evidence capture. Payload version, submission timestamp, response codes, and acknowledgements. Not we can retrieve it from the provider portal. If the audit story depends on a third-party UI, you don't have evidence. You have a subscription. And here's the cynical part. Vendors will happily sell you one integration that works for the demo country. Then reality arrives. Version changes, new validation rules, outage behavior, and exceptions that multiply. Adapters rot without governance. That's not a vendor problem. That's entropy. And you either design against entropy or you pay it forever. So pick your rail model per country if you must, but design your architecture as if both exist. Interoperability and clearance are just different front doors to the same back room. Regulated transaction data with proof. Once you accept that, you can move forward without betting your program on one perfect standard winning everywhere. And that sets up the first real anchor workflow. Dynamics invoice to E-invoice to DRR, with an audit trail you can defend. Workflow 1 overview. Dynamics 365 Finance invoice to DRR with a defendable audit trail. Here's workflow 1 in the only form that matters. Can you take a posted invoice in Dynamics 365 Finance and prove, without theater, that the exact same transaction was digitally reported, accepted, or rejected with traceable reasons, corrected if needed, and stored with evidence that survives an audit? Because under ViDA, the audit question stops being, did you file? It becomes, show me the chain of custody for this invoice. And if your answer is a shared drive and a provider portal login, you don't have a chain of custody. You have a future argument, start where truth starts, posting. Dynamics 365 Finance is the system of record. That means the moment the invoice posts, your VAT outcome is no longer a draft opinion. It's an accounting fact you're about to transmit to a government system on a deadline. So the first architectural requirement is brutal. Your tax determination result has to be final grade at posting time. If your process depends on, we'll review tax later, then your real system of record is not D365. It's a human inbox that won't survive transaction speed reporting. Now, the second requirement, define a canonical invoice object, not a PDF, not an XML file, an internal versioned representation of the invoice as regulated data. This is where most enterprises quietly collapse into mapping spreadsheets and hope. Don't do that. Your canonical object should reflect EN 16931 semantics, seller, buyer, VAT IDs, addresses, line-level tax categories, totals, payment means, and the pieces that consistently trigger rejection when you let them drift. You map D365 fields into that canonical object once with governance, and you decide explicitly where extensions live, because you will have internal fields that don't belong in a regulated packet. Fine, keep them. Just don't contaminate the semantic contract. Then you build the event, invoice posted. This isn't philosophical, it's operational. When the invoice posts, you emit an event that includes stable identifiers, company, invoice number, internal record ID, posting timestamp, and whatever you need to retrieve the full canonical payload deterministically. From there, you generate the regulated payload and persist it. Persist it before you transmit it. That's the line that separates adults from enthusiasts. If you generate on the fly and then call an API, you've created a system where you can't prove what you sent if the upstream data changes later. Under audit, it should have been the same is meaningless. You store the exact payload with a hash if you want to be extra honest with yourself, and you treat it as immutable evidence. Now, you submit to DRR through the rail that applies interoperability or clearance, and you record the response. And no, record the response doesn't mean log a 200 OK in an integration runtime. It means capture the meaningful artifacts, submission timestamp, rail identifier, message ID, acknowledgement or rejection code, and any validation errors that the rail provides. If you can't tie the response back to the specific payload version, you've built a story, not a control. At this point, your workflow splits into two equally important branches. Branch 1 is success. You mark the invoice as reported, you store the acknowledgement, and you make it queryable, not in a PDF archive. In structured storage, you can report on. Branch 2 is rejection, and this is where your design either scales or collapses. A rejected invoice must enter an exception lifecycle: triage, remediation, resubmission, and correction trail. Power Automate is the obvious orchestration layer here because it can route the exception to the right owner based on rejection category, master data, tax coding, totals, timing, duplicate number, missing VAT ID. It can enforce that remediation happens in the system of record, not in a sidecar spreadsheet. And it can require evidence capture: who changed what, why, and what got resubmitted. You also need one more rule: idempotency. If you resubmit the same invoice payload, the rail must not treat it as a brand new transaction. Your submission design needs stable idempotent keys tied to the invoice identity and payload version. Otherwise, outages create duplicates, duplicates create corrections, and corrections create permanent exception debt. Finally, the visibility layer. Power BI doesn't exist here to impress anyone. It exists to stop silent failure. You track submission success rate, rejection categories, exception aging, and time from posting to reported. That last one is the killer metric because it exposes process drift long before you miss statutory deadlines. This is workflow number 1. Post in D365, compile regulated payload, persist it, submit it, capture acknowledgement, route exceptions, and expose health daily. Not glamorous, deterministic. Master data is now a tax control surface. Workflow 1 only works if the invoice can compile. And the invoice only compiles if your master data stops behaving like helpful defaults and starts behaving like regulated inputs. That's the shift. Master data becomes a tax control surface. Most organizations treat customer and product master data as operational convenience. Sales wants speed, finance wants enough to post, and everyone quietly accepts that the real cleanup happens later. Under ViDA timelines, later is not a phase, it's a failure mode. Start with the most common break: customer VAT ID. If the VAT ID is missing, malformed, or attached to the wrong legal entity record, your invoice payload either fails validation or creates mismatches when the purchaser reports their side. And because the research points to transaction-level reporting and fast deadlines, the mismatch becomes visible quickly. You don't get months of ambiguity, you get immediate exception traffic. Now here's the thing most people miss. A VAT ID check is not a courtesy lookup, it's evidence. In the research, VS shows up as the obvious reference point for VAT ID validation. Whether you validate through VIS or another governed mechanism, the architectural requirement is the same. You need to record that you checked, what you checked, when you checked, and what result you got. Otherwise, you're relying on a human memory of, we usually validate that. Audits don't accept usually. So in a Microsoft stack, you want the validation result to become part of the transaction context. Not a note, not an email, a structured attribute tied to the customer record and, where appropriate, captured again at transaction time. Next, addresses. Everyone thinks address fields are boring until they're wrong. Under structured invoicing, address normalization stops being cosmetic because it affects identification, place of supply logic in some scenarios, and basic invoice completeness rules. Free text addresses, inconsistent country codes, and half-populated fields don't just look messy. They generate rejections and disputes. Then there's product and service classification. Most ERPs tolerate sloppy item categorization because finance can still post revenue. ViDA doesn't reward that. If your tax determination depends on whether something is a service, a good, a specific category, or subject to special treatment, then miscellaneous becomes a tax risk generator. And if your tax outcome is wrong, your e-invoice semantics can be perfectly formatted and still represent the wrong truth. That's worse than rejection. Rejection is loud, wrong truth is silent. Banking details also show up as a practical constraint. In the webinar transcript, they call out that the supplier needs to include bank account data on the invoice, and they mention extra requirements around credit invoicing and sequential numbering discipline. That means bank account data stops being kept somewhere in finance. It becomes a regulated invoice field with correctness expectations. If you let multiple bank accounts float around with no governance, you will eventually send the wrong one in a regulated packet. And then you get to explain that mistake to customers and authorities at the same time. This is where first-time right stops being a slogan and becomes survival. Real-time or near real-time reporting kills month-end cleanup because your cleanup window shrinks to the operational window between invoice posted and deadline reached. If your process assumes that master data issues are rare, your process is lying. Master data issues are common. They were just hidden by delay. So what does master data as a control surface look like in Dynamics 365 Finance Plus Power Platform? It means you add preventive controls where the system can actually enforce them. You validate VAT IDs at customer onboarding and again when needed at transaction time. You constrain country and currency codes. You make certain fields non-optional. because your regulated outputs require them. You standardize address structures. You stop letting users override tax-relevant attributes without leaving a trace, and you make those controls visible. Power Automate becomes the mechanism for master data exception routing. Missing VAT ID, invalid format, inconsistent address, product classification gaps. It assigns ownership and forces remediation before you generate a regulated payload, not after the rail rejects it. Power BI becomes your master data truth serum. Which entities generate the most invoice rejections, which fields are most often missing, and which business units are creating exception debt faster than they resolve it. If you can't see that trend, you can't stop it. And the cynical reality is this: master data controls always erode unless you enforce them by design. Someone will ask for a bypass, someone will need to ship, someone will override a field just this once. Those exceptions accumulate. Under ViDA, they don't just accumulate quietly, they become measurable failure, daily. So treat master data as part of the ViDA pipeline, not a prerequisite project you'll get to later, because the invoice is only as compliant as the weakest master record that feeds it. And once you accept that, the next uncomfortable truth is obvious. Exceptions aren't edge cases, they're the product. Exceptions are not edge cases, they are the product. Most teams talk about exceptions like they're debris, an occasional bad record, a weird customer, a one-off credit note. Clean it up and move on. That mental model dies under ViDA. Under transaction speed reporting, exceptions are not rare, they are guaranteed. And the only real question is whether you designed an exception system or whether you accidentally created one out of inboxes, spreadsheets, and panic. Because exceptions don't come from bad people or bad software. They come from normal enterprise behavior. Incomplete onboarding, rushed postings, pricing corrections, retroactive discounts, disputes, returns, partial shipments, and the eternal truth that no sales system and no finance system ever agree perfectly in real time. Now apply ViDA's constraint. The regulated payload has to be issued and reported inside a tight window, and it has to be coherent enough to survive validation and matching. That means every exception turns into a clock, and clocks create operational pressure. Operational pressure creates shortcuts. Shortcuts create more exceptions. This is how exception debt becomes permanent. So let's be concrete about what exceptions actually look like in this world. You'll see hard validation failures, missing VAT IDs, invalid VAT ID formats, inconsistent country codes, unsupported tax category codes, totals that don't add up the way the schema expects, missing bank details where required, duplicate invoice numbers, credit notes that don't link cleanly to the original. You'll also see timing failures, invoice posted but not issued in time, issued but not submitted in time, submission stuck during an outage, purchaser-side reporting mismatches that surface as disputes or follow-up queries. And those are the exceptions that hurt most because they aren't wrong data, they're wrong process behavior. And then there's the quiet category. Semantic failures. Everything passes schema validation, but the business meaning is wrong. Wrong customer classification, wrong reverse charge treatment, wrong place of supply assumption, wrong product taxability. Those don't bounce. They settle into your ledger as false confidence. So if exceptions are inevitable, the architecture goal shifts. You don't aim for no exceptions. You aim for a deterministic exception lifecycle that you can run daily, at volume, without turning your tax function into a ticket desk. A usable lifecycle has 4 stages, and if you skip any of them, you create chaos. First, triage. Every rejection or mismatch must land in one place with enough context to decide what it is. Not invoice failed, why did it fail, who owns the fix, and what's the deadline clock. If you can't answer those 3 things in the first minute, you've already lost. Second, remediation. The fix must happen in the system of record, not in the payload. If you patch the XML and resubmit without correcting Dynamics 365 Finance or the upstream master data, you've created a forked reality. Forked reality is audit fuel. Third, resubmission. Resubmission must be controlled and idempotent. Same invoice identity, new payload version, traceable link to the correction reason. If your resubmission can accidentally produce duplicates, you'll spend your life issuing credit notes to cancel your own mistakes. Fourth, correction trail. Every change needs a reason, an actor, a timestamp, and a link between the original and the corrected representation. Not because it's nice governance, because under ViDA the entire point is that transactions become inspectable. If your corrections aren't inspectable, you're just generating noise faster. This is where Power Platform earns its keep. Power Automate isn't just moving data, it's enforcing the lifecycle. Create an exception record when a rejection arrives, classify it, route it to the owner, require remediation steps, and only then trigger resubmission. And when humans have to intervene, Automate can force them to leave evidence behind, what they changed and why. Power BI is the part nobody wants at first because it exposes reality. You need a small set of KPIs that make exception debt visible. Exception rate, exception aging, rejection category distribution, and time from posting to accepted. Those numbers will look ugly in the beginning, Good. That ugliness is the map of where your architecture leaks tax truth. And you also need ownership. If tax owns the rules, finance ops owns the postings, IT owns the rails, and nobody owns the exception queue end to end, you've built a system that cannot improve. The queue will grow until the business demands bypasses, and then your deterministic model collapses back into probabilistic chaos. So treat exceptions as the product, the operational surface where ViDA either becomes manageable or becomes a permanent crisis. Once you build that product, the next awkward topic appears immediately. Summary invoices and credit notes, the places where legacy convenience still exists, but only on a leash. Summary invoices, credit notes, and the death of casual adjustments. Summary invoices are where legacy process tries to survive. And yes, ViDA still allows them, but only in a way that exposes how much enterprises used batching as a hiding place. In the webinar research, the speakers make it explicit. Transaction-level reporting is the default, but summary invoices remain possible only within tight conditions, bundled within the same month the transactions occurred, and then issued within 10 days after that month ends. So you don't get "we'll summarize the quarter." You don't get "we'll catch up later." You get a narrow window where batching exists as a controlled exception, not as your operating model. That distinction matters because summary invoices aren't a paperwork decision anymore. They're an architectural decision. You're choosing to compress multiple supplies into one regulated packet. That means your system must still retain line-level and transaction-level traceability internally because disputes, corrections, and audits don't accept it was in the summary. They ask, which underlying transaction produced this line, and where is the evidence? Now here's where most organizations get hurt. They use summary invoices today because their operational systems can't keep up with invoice issuance at transaction speed. They ship, they deliver, they settle, and then they invoice in batches because the data is messy and the people are busy. Under ViDA, batching isn't a fix for that mess. It's just a different way to package the mess and then transmit it on a deadline. So if you plan to use summary invoices, you need to treat the underlying transaction set as a governed unit, a stable selection rule, stable identifiers for each included supply, a deterministic way to reproduce the summary contents later, and a correction model that can surgically fix one underlying item without tearing the whole bundle apart. If you can't do that, summary invoicing becomes a denial strategy. And denial strategies don't survive real-time reporting. Now, credit notes. Credit notes are where casual adjustments go to die because ViDA compresses the correction lifecycle and forces traceability. The webinar calls out extra requirements around credit invoicing and sequential numbering discipline, and it's the predictable direction of travel. If you correct, you must link. If you link, you must be consistent. If you're consistent, you can be audited without argument. This is the core shift. Corrections stop being accounting convenience and become regulated events. In a periodic world, a credit note could be a blunt instrument. You could write one at month end to true up a mess. Rebates, returns, pricing disputes, we'll just credit them 3%. It might still be legally acceptable, but it lived in a low observability environment where the authority saw it later aggregated and usually without the context that produced it. Under ViDA-style timelines, that correction becomes visible quickly and comparable across parties. The purchaser side reports too. Mismatches don't sit quietly in a reconciliation spreadsheet. They surface as detectable behavior. So credit notes must behave like linked amendments. They need a clean reference to the original invoice identity. They need sequencing discipline that doesn't drift. And they need a correction reason that isn't free text theater, but a categorization you can report on and defend. This is where finance operations need to stop treating adjustments as a normal escape valve. Because adjustments are entropy generators. They accumulate, they hide underlying data quality failures, and they turn your regulated pipeline into a perpetual exception machine. In Microsoft terms, this is a lifecycle design problem. Dynamics 365. Finance has to represent credit notes and corrections in a way that maintains linkage and numbering discipline, and it has to do so consistently across business units. If different teams correct in different ways, some with credit notes, some with negative invoices, some with manual journals, you'll create multiple representations of the same business reality. Under ViDA's observability, that becomes confusion you can't reconcile. Power Automate becomes the governor. When a correction is required, Automate should route it through a controlled flow. Identify the original invoice, choose the correction mechanism that matches policy, require the minimum evidence, and ensure the resubmission happens with traceable linkage. And importantly, it should prevent the lazy path. If someone tries to bypass with a journal entry that breaks the chain of custody, the system should refuse it because "we needed it fast" is not a compliance argument. And Power BI becomes the accountability layer. You track how many corrections you're generating, why you're generating them, and where they originate. Customer master data, pricing, tax coding, timing, duplicate numbering, or operational disputes. If correction volume climbs, your system is decaying, quietly, daily. So yes, summary invoices still exist. Credit notes still exist. But the era of casual adjustments is over because ViDA makes every correction a regulated, inspectable event. And once corrections become events, you either design the chain of custody or you spend your life explaining why it broke. Finance operations under ViDA, less clerical work, more systems thinking. Once you accept that invoices are regulated packets and corrections are regulated events, finance operations stops being back office. It becomes part of the control plane. That's not a compliment, it's a consequence. In the periodic world, finance ops could survive on rhythm, post during the month, fix at month end, reconcile in a few heroic sprints, file and move on. People built careers on being good at cleanup. They knew where the bodies were buried, which customers always had missing VAT IDs, which business unit loved free text tax codes, which country team never matched the sales listing on the first try. ViDA removes the hiding place. With transaction-level reporting and short issuance windows described in the research, the cleanup buffer collapses, so the work changes shape. There's less clerical effort that can be deferred, and more systems thinking that has to happen continuously. What is the pipeline doing today? Where is it drifting? And which control is failing? This is why the webinar line about roles drifting isn't optional. They said the compliance specialist becomes also IT specialist a bit. That's exactly right, and it's exactly what most organizations resist. Not because they disagree, but because it breaks the old contract. Tax defines rules, finance posts transactions, IT runs systems. ViDA turns that into one pipeline with shared failure modes. And the practical reason is simple. The problem isn't how do we file VAT. The problem is how do we prevent invalid transactions from becoming regulated outputs. That's operations, not policy. So what changes inside finance operations? First, ownership shifts from periods to queues. Under ViDA, the unit of work isn't close the month. It's drain the exception queue. Rejections, missing data, mismatches, timing breaches, duplicate numbering issues, those are no longer edge cases. They're daily work. And if you don't operationalize that queue, it grows until the business demands bypasses and then your control plane becomes decorative. Second, the close compresses. Not because the law says close faster, but because real-time visibility makes delay indefensible. If you can see daily that 6% of invoices are stuck in exception state, then month-end becomes the moment you discover whether you managed the pipeline or ignored it. This is where the system punishes you. Exception debt compounds quietly, then explodes during the close when everyone is tired and shortcuts look reasonable. Third, automation becomes mandatory. Not nice, mandatory. The webinar described volume and deadlines making manual work impossible, and that's not rhetoric. If invoices must be issued and reported inside tight windows and both sides report, the number of touch points multiplies. Humans can fix a dozen exceptions. They can't fix thousands with evidence, linkage, and traceability. So you either automate triage and routing, or you accept that your compliance posture is probabilistic and collapsing. This is where Microsoft's stack fits without pretending it's magic. Dynamics 365. Finance remains the system of record, but finance operations has to treat it like a regulated event generator. That means standardizing posting practices, numbering policies, credit note behaviors, and master data requirements across business units. If one team posts their way, you don't get flexibility. You get ungoverned variance. Variance is an entropy generator. Power Automate becomes the operational fabric, not for approvals in the abstract, for deterministic exception routing. Who owns this failure? What remediation is allowed? What evidence is required? And what gets resubmitted? You don't want creativity here. You want repeatable paths that produce the same outcome regardless of who is on shift. Power BI becomes the daily control room, not a reporting artifact for leadership. A working instrument for operations, exception rate, exception aging, success rate, and time to issue. Those metrics answer the only question that matters under ViDA. Are you compliant today, or are you accumulating failure that will surface later? And here's the organizational consequence nobody budgets for. Tax, finance ops, and IT now share one pipeline, or entropy wins. If tax designs rules that finance can't execute at speed, the queue explodes. If finance posts transactions that IT can't reliably transmit and prove, the evidence breaks. If IT builds rails without operational ownership, exceptions become someone else's problem and stay unresolved. The system doesn't care whose job title is on the org chart. It will surface the failure where the pipeline breaks. So yes, there will be less clerical work eventually because structured data and automation remove some manual touchpoints. But in the transition, finance operations becomes more technical, more continuous, and more accountable. And that's why the next topic matters. When platforms become the tax counterparty, operations stops being a department. It becomes product design. Pillar 2 in one sentence. Platforms become the tax counterparty when sellers aren't. Pillar 2 is the part most enterprises ignore because it sounds like it's for ride-sharing apps and holiday rentals. That framing is comfortable. It's also how you miss the point. In one sentence, Pillar 2 says this. When the underlying seller isn't the party the tax authority can reliably collect from, the platform becomes the tax counterparty. Not the messenger, not the marketplace. The counterparty. The research is clear on scope in the compromise package, short-term accommodation and passenger transport. And it's also clear that the original proposal was broader, including more e-commerce platform deeming, but that got cut back in the final agreement. That reduction doesn't make this pillar small. It just makes it more targeted, because the mechanism is the real change, and mechanisms spread. Once a regulator proves that moving liability to the platform increases collectability, that pattern doesn't stay in one box forever. Systems copy successful control patterns. Always. Now, what triggers the deemed supplier treatment in the material you provided? The webinar describes it bluntly. If the underlying supplier isn't obliged to pay VAT, or the supplier doesn't provide a VAT number, the platform needs to charge VAT on sales made via the platform and remit it to the authorities. The platform has to check the status, collect evidence, and decide whether it is responsible. That means your platform needs a decision engine. And decision engines are where good intentions go to die if you don't enforce them with design. Because does this supplier have a VAT number? Sounds like a simple field. In reality, it's onboarding, validation, lifecycle, and audit trail. VAT numbers change, supplier status changes, people type garbage into forms, and if your platform can't prove that it asked, checked, and classified correctly at the time of the transaction, you're not running a platform. You're running conditional chaos with payment rails attached. Here's the uncomfortable truth. Pillar 2 makes tax a runtime concern in product design. It reaches into your marketplace onboarding flow, your pricing display, your checkout calculation, your invoicing logic, your refund flow, and your payout statements. It's not a finance back office issue anymore because liability is determined at transaction time based on seller status and evidence captured at that moment. So, in architecture terms, a platform under ViDA needs 3 things that most platforms don't build deliberately. First, identity and status capture. You need to represent the seller as an entity with tax-relevant attributes. VAT registration status, VAT number where applicable, and whatever other status flags your tax team will insist on later. The key is not the fields. The key is that the platform must treat these as controlled inputs, not optional profile data. Second, decision logging. Every transaction needs a recorded decision. Platform is deemed supplier or platform is not deemed supplier, and that decision must be reproducible. Not, we usually treat these sellers as non-registered. Reproducible with linked evidence. What data was present, what validation was performed, and when. Third, reversible accounting. Platforms live on refunds, cancellations, chargebacks, and disputes. If you become the VAT counterparty, you also become responsible for reversing VAT correctly when the commercial transaction reverses. If your refund pipeline can reverse money but not reverse tax with traceable linkage, you've created a regulatory drift machine. It will look fine in aggregate until it doesn't. Now anchor this back to the Microsoft ecosystem, because that's where people keep getting this wrong. If you run a platform like Model, Dynamics 365 Finance doesn't magically solve the deemed supplier logic. Finance will post what you tell it to post. The liability decision has to happen upstream in your platform transaction layer and then land in finance as an accounting truth. Who supplied what, who invoiced whom, and which VAT treatment applies. Power Platform becomes the operational glue when reality breaks. Power Automate can govern seller onboarding exceptions, missing VAT numbers, failed validations, and evidence capture. Power BI can show you how often the platform is becoming deemed supplier, where exceptions cluster, and whether your VAT collected aligns with your deemed supply decisions. And yes, this pillar still collides with Pillar 1 and Pillar 3. If the platform becomes the supplier, invoices still have to exist in structured form where applicable. Reporting still has to reconcile. OSS still becomes relevant for cross-border B2C flows. The pipeline doesn't care that you call it platform rules. It's still calculate, report, settle, file, prove. Pillar 2 just changes who is on the hook when the underlying seller isn't. Platform operating model redesign. Pricing and contracts stop being business only. Once the platform becomes the tax counterparty, the operating model stops being a commercial abstraction. It becomes a set of tax-bearing decisions. What the buyer sees, what the seller agrees to, what the platform retains, and what gets remitted. And the system will enforce those decisions, whether you designed them or not. Start with pricing display, because that's where liability turns into customer experience. If your platform shows tax-inclusive prices in one market and tax-exclusive in another, you're not just changing a UI label, you're changing expectations about what the price means. Under a deemed supplier model, the platform may be the one calculating and charging VAT, which means the platform owns the accuracy of that displayed price. When the tax engine is wrong, the customer doesn't blame the underlying host or driver, they blame the platform. That's not moral judgment, it's behavioral reality. So the platform has to decide explicitly, are we presenting gross prices, net prices, or a hybrid with tax breakdown? And whatever you choose has to be consistent with how you invoice, how you settle, and how you reverse. Because refunds are where "we'll fix it later" goes to die. If you refund a gross amount, you must reverse the VAT correctly. If you refund a net amount and adjust fees separately, you must still reverse VAT in proportion to what was actually charged. If your workflow can't do that deterministically, your accounting will drift and your reporting will become a probabilistic model. Now, contracts. Most platforms treat contracts like a legal wrapper around product behavior. Terms of service, seller agreements, payout terms. Under Pillar 2, contracts become tax architecture. They define who supplies what, who invoices whom, and what evidence the platform can demand from sellers to make the deemed supplier decision. This is where ambiguity creates double taxation or non-collection. If the platform contract describes the platform as merely an intermediary, but the platform is treated as deemed supplier for certain transactions, you've created a split-brain model. The legal language says "not us," while the tax rule says "you." That mismatch isn't theoretical. It appears as disputes when sellers see VAT withheld or when buyers receive invoices that don't match their expectation of who supplied the service. So the contract has to align with operational reality. Who is the supplier of record in deemed scenarios? What data the seller must provide, and what happens when they don't? What the platform is allowed to do when seller status changes, how corrections, cancellations, and chargebacks affect VAT treatment. And yes, this is painful, because it forces product and legal to stop writing flexible language and start writing deterministic commitments that the systems can execute. Next, payouts. Payout statements look like a finance detail until you realize they are the audit story customers and sellers actually read. Under deemed supplier, the platform might collect the full amount from the buyer, then retain fees, retain VAT to remit, and pay the remainder to the seller. If your payout statement can't explain that clearly, you will generate disputes at scale. And disputes become operational load, which becomes shortcuts, which becomes exception debt. The payout statement needs to reconcile these numbers cleanly. Gross charge to buyer, VAT charged and retained for remittance where applicable, platform fees, and whether fees themselves have VAT treatment depending on the scenario. Net paid out to the seller. And it needs linkage to transaction identifiers that also tie back to invoicing and reporting identifiers. Otherwise, your platform ledger and your tax ledger become two narratives that can't be reconciled without heroics. Now the ugly part. Refunds, cancellations, and chargebacks. Platforms live in reversals. And reversals under Pillar 2 aren't just reverse the payment. They are tax events. If you can't reverse VAT correctly and link that reversal back to the original transaction and invoice representation, you'll accumulate tiny mismatches that turn into big compliance headaches once reporting becomes near real-time and cross-validated. So architecturally, you need a reversal model that is transaction-linked, not period-adjusted, not "will adjust VAT in the next return." That's the old world. The new world is correction trails exist and mismatches are detectable. This is where the Microsoft stack should be positioned carefully. Dynamics 365, finance is where the accounting truth lands. Gross, fees, VAT liability, and payables. But the platform system is where the decision is made and where the evidence is captured. If you feed finance a summarized journal without transaction context, you've made finance blind. Blind systems can't prove. Power Platform is the bridge. Power Automate can enforce seller onboarding completeness, root missing VAT number issues, and gate payouts when evidence is missing. Power BI can expose the operating model metrics you actually need. Deemed supply share, dispute rate tied to VAT withholding, refund-driven VAT reversals, and reconciliation gaps between platform ledger and finance. Pricing, contracts, payouts, reversals. Under ViDA, those aren't business-only decisions. They're the platform's tax control plane. Platform evidence, identity checks, location proofs, and auditability. If Pillar 2 makes the platform the tax counterparty, evidence becomes the platform's real inventory. Not listings, not rides, not nights booked, evidence. Because the platform's liability decision isn't judged by how reasonable it sounded at the time. It's judged by whether it was provable later, transaction by transaction, with inputs that existed at runtime. So the platform needs two evidence tracks that never get to be best effort: merchant status and location. Start with merchant status because the deemed supplier mechanism in the webinar hinges on whether the underlying supplier is obliged to pay VAT or provides a VAT number. That means the platform must collect the VAT number when it exists, validate it when it matters, and store the outcome as evidence, not as profile decoration. Most platforms do this backwards. They collect a VAT number once during onboarding, then treat it as a permanent truth. That's how you end up charging or not charging VAT based on stale data. Under a control plane model, stale data is indistinguishable from negligence. So the platform has to treat VAT status as a lifecycle state: present, missing, invalid, unverified, verified at date, changed. And it needs to bind that state to each transaction decision. Seller is VAT registered isn't a global claim. It's a claim at the moment of supply, backed by whatever validation mechanism you used. And if the seller won't provide a VAT number, the platform still can't shrug. The platform must record that absence as part of the decision log. Asked, not provided, therefore deemed supplier logic applied. That distinction matters because audits don't argue about intent. They argue about evidence. Now, location. Location is where platforms lose control first because location data is messy, multi-sourced, and politically sensitive. But VAT rules don't care about sensitivity. They care about place of supply logic and the ability to defend it. And the practical problem is that a platform's where is often computed from weak signals. Billing address, IP, device region, pickup location, property address, bank country, and whatever the user typed at 2 a.m. So the platform has to decide which signals are authoritative for which transaction type and then capture the signals used for the decision. Not all signals, the signals that matter for the determination. If you can't state we used property address and booking dates for accommodation or we used pickup drop-off jurisdiction for passenger transport, you're not determining tax. You're guessing, and once you're guessing, you'll build inconsistent outcomes across refunds and chargebacks, because the reversal process will grab a different signal than the original sale. That's how you create drift. The text treatment changes because the data source changed, not because the transaction changed. So architecturally, the platform needs a location evidence bundle per transaction. The inputs used, the resolved jurisdiction, and the timestamp. Then when the transaction reverses, the platform uses the same bundle to reverse tax consistently. Now, auditability. Auditability is not we store logs. Auditability is can you reconstruct the decision and the payload without trusting any live system state. That means the platform needs to retain the proofs and decisions linked to the transaction record, the seller status used at the time, including VAT number if provided and validation result if performed, the location evidence used to determine the treatment, the decision outcome, platform deemed supplier or not, the invoicing representation if the platform issued invoices including identifiers, the payout representation, gross, fees, VAT retained, net payout, linked to the same transaction identity, and the correction trail when anything changes, because anything will change. A seller updates their VAT number, a booking gets cancelled, a ride gets disputed, a chargeback arrives 3 weeks later. If your system can't maintain the chain of custody through those changes, you'll spend your time arguing about which version was the real one. It's never a fun argument. So how does this map into a Microsoft ecosystem architecture without turning into a science project? Dynamics 365. Finance is where the platform's accounting truth lands, but the evidence can't live only in finance. Finance is not an evidence warehouse, it's an accounting system. If you force it to hold every proof artifact, you'll create an unmaintainable data model and still fail to answer audit questions quickly. Instead, treat the evidence bundle as a governed record attached to the transaction in an evidence store, with durable identifiers that finance can reference. Power Platform becomes the control surface for the evidence lifecycle. Power Apps can enforce seller onboarding fields and prevent half-registered sellers from transacting. Power Automate can route validation failures, request missing VAT numbers, and block payouts when evidence requirements aren't met. And Power BI becomes the uncomfortable dashboard that shows where evidence quality is decaying. How many sellers have unverified status, how many transactions relied on weak location signals, and how many reversals failed to match the original decision bundle. The failure modes are predictable. Ambiguous seller roles create double taxation or non-collection. Weak location proofs create inconsistent treatment and unprovable decisions. Missing retention creates we can't reconstruct what happened, which is just another way of saying we can't prove compliance. So in Pillar 2, evidence isn't paperwork. It is the platform's ability to survive being the counterparty. Deemed supplier meets E-invoicing, DRR, reconciliation, or collapse. This is where Pillar 2 stops being a platform tax discussion and collides with Pillar 1 like a truck. Because once the platform becomes the deemed supplier, it doesn't just collect VAT. It owns the regulated story, the invoice, the reporting, the corrections, and the proof. And under ViDA, those artifacts have to reconcile across systems that were never designed to agree at transaction speed. Deemed supplier logic creates a new invoice issuer. Sometimes that issuer is the platform. Sometimes it's the underlying seller. The problem is not choosing. The problem is that your systems must behave consistently with that choice, every time and at volume. If the platform issues the invoice, that invoice still has to align with EN 6931 semantics where the rule applies, and it still has to feed digital reporting requirements on the deadlines your rail enforces. That means your platform is now an e-invoicing producer, not just a marketplace. And if you treat that as will generate an XML, you're building a compliance facade that collapses the first time refunds and chargebacks hit. The reason this is fragile is simple. platforms don't run on invoices. They run on events: bookings, rides, cancellations, adjustments, fees, payouts, disputes, partial refunds, chargebacks. Each of those events changes the economic reality, and under a deemed supplier model, each one can change the VAT reality. Now add Pillar 1. Near real-time reporting turns those changes into visible, comparable deltas. So the architectural question becomes brutally narrow. Can the platform reconcile three ledgers continuously? The customer-facing ledger: what the buyer was charged including VAT and what was refunded. The seller-facing ledger: what the seller earned, what fees were retained, and what VAT was withheld or remitted by the platform. The tax-facing ledger: what was reported via DRR, what acknowledgements were received, what corrections were submitted, and what is currently considered the truth by the authority rail. If those three don't tie out, the system doesn't just become messy, it becomes undefendable, and in a transaction control model, undefendable becomes detectable quickly. Here's where most people mess up. They build the deemed supplier logic as a pricing rule, but leave invoicing and reporting as an afterthought. So the platform charges VAT, posts some accounting entries somewhere, and then later tries to figure out reporting. That is backwards. Under ViDA, reporting is not downstream. Reporting is part of the transaction lifecycle. The fix is not complicated. It is just unforgiving. You need one transaction identity that survives the entire lifecycle. Order or booking ID, any invoice IDs generated, any DRR message IDs, any refund and correction IDs, and the payout statement reference. If you don't have stable identity, reconciliation is manual forever. Then you need a state machine that spans both commerce and tax. Not just paid and refunded, but invoiced, reported, acknowledged, rejected, corrected, resubmitted. Those states aren't optional metadata. They decide whether your VAT collected equals VAT reported. And once those states diverge, you are no longer managing VAT. You are managing variance. Now translate that into the Microsoft stack without pretending it's one product feature. Dynamics 365, finance remains the system of record for the accounting truth: VAT, liability, fees, payables, cash movements, but the deemed supplier decision happens upstream in the platform transaction system, and the evidentiary context must travel with it. So finance needs transaction-grade references, not summarized journals that erase identity. Power Platform becomes the orchestration and visibility layer that prevents collapse. Power Automate should handle the moments where commerce events force tax events. A cancellation triggers a credit note or correction. A chargeback triggers a reversal workflow. A seller status change triggers validation and, potentially, a different deemed supplier outcome for future transactions. And every one of those flows must attach evidence and linkages so you can prove the decision lineage later. Power BI is where you stop lying to yourself. You need dashboards that answer: what share of transactions are deemed supply, what share successfully reported, how many are stuck in exception states, and where reconciliation gaps exist between platform ledger, finance, and DRR acknowledgements. If you can't see that daily, you will discover it during an audit window, which is the worst possible time to learn the system drifted. And yes, near real-time visibility makes mismatches immediately detectable. That's the point. ViDA reduces fraud by turning delay into observability. The system will show you your inconsistencies faster than your organization can explain them. So Pillar 2 meeting Pillar 1 gives you exactly two outcomes. Either you engineer reconciliation as a first-class product, stable identity, deterministic states, and evidence-linked corrections, or you operate a platform that can charge VAT but can't prove why, can't reconcile what happened, and can't survive regulated reporting at speed. That isn't a compliance risk. That's a business model risk. Pillar 3 in one sentence: fewer registrations, stricter truth. Pillar 3 is where everyone relaxes because it sounds like simplification. Single VAT registration, OSS expansion, fewer local VAT numbers, less admin. And yes, that's directionally true, but it hides the trade. The registration footprint shrinks while the truth requirements expand. That is the bargain. In the webinar research, the one-stop shop is framed as the mechanism that lets a business charge local VAT in multiple member states, but pay and report it through its home authority. That reduces the need to register locally, file locally, and correspond locally. Enterprises love that story because local registrations are expensive and bureaucratic, and they tend to multiply quietly over time. But the system doesn't delete complexity, it relocates it. Under an expanded OSS model, the tax authority still expects the correct VAT to be charged per destination, per category, per rate. The difference is that you're now aggregating and paying centrally. So the compliance surface doesn't get smaller, it gets more concentrated. And concentration means two things: better leverage when you get it right, and faster failure when you don't. The first foundational constraint from the research is the one most teams discover too late. Local input VAT can't be deducted in the OSS return. The webinar says it directly. Output VAT goes through OSS. Local input VAT comes back through a separate refund route with drag and timing cost. That means OSS is not just a reporting decision, it's a treasury decision. If you're incurring material input VAT in a country, warehousing, local marketing, returns handling, events, repairs, then deregister everywhere can create a cash flow problem you didn't model. So Pillar 3 forces an enterprise to run an explicit strategy. Where do we stay locally registered because we need input VAT efficiency? And where do we accept OSS plus refund friction because the admin savings outweigh the cash cost? And the second constraint is even more uncomfortable. OSS simplifies filing, not evidence. You still need to prove what you sold, where it was taxed, why the rate applied, and how you computed it. The only difference is that the evidence pack now needs to support central aggregation. This is where enterprises break systems. They treat OSS as one portal solves everything, and then they discover their order systems don't store the location evidence consistently, their tax engine changes rates mid-period without traceability, and their FX handling creates drift between what was charged, what was settled, and what was reported. Because under Pillar 3, cross-border truth becomes an accounting product. Destination, rate, taxable amount, tax amount, currency, and timestamp all tied to a transaction identity you can audit. So architecturally, the key shift is registration footprint shrinks, data completeness expands. You can't rely on local accountants to make sense of it in each country anymore because you're explicitly centralizing. That means your systems have to carry more of the burden: classification, place of supply logic, exemptions, customer status, and the evidence that supports those decisions. And this is where reverse charge expansion starts to matter because it's part of the same operating model. In the webinar, they describe reverse charge as a simplification. Non-established supplier invoices without VAT, customer accounts for VAT, and by 2028 it broadens to many scenarios when the supplier isn't established and the customer has a local VAT number. That reduces registrations? Great. But it punishes sloppy customer classification. If you can't reliably decide whether the customer is taxable, has a valid VAT number, and meets the conditions, your invoicing flips between VAT charged and reverse charge incorrectly. Under transaction-level controls and cross-validation, those errors don't hide. They surface as disputes, mismatches, and correction traffic. So Pillar 3 isn't less work, it's different work. It turns VAT into a centralized data discipline problem. Now map that to the Microsoft ecosystem without pretending you can configure your way out of it. Dynamics 365. Finance remains the accounting truth. Liabilities, postings, and the ledger logic that must reconcile. But finance can't invent evidence it didn't receive. If your commerce and billing systems don't attach destination and status data to each transaction, finance will dutifully post the wrong truth consistently. Power Platform becomes the way you operationalize the stricter truth. Power Automate routes the exceptions that Pillar 3 creates. Missing evidence, invalid VAT IDs, ambiguous customer status, rate disputes, and refund adjustments that need to land correctly in the OSS aggregation model. Power BI becomes your visibility layer. Liability by member state, variance between expected and collected VAT, and days to close for the VAT period as a measurable indicator of architectural health. Fewer registrations is real. But it comes with stricter truth because you can't decentralize ambiguity and still centralize reporting. And that sets up the next workflow: checkout tax to OSS IOSS return preview with evidence and FX discipline that actually ties out. Workflow 2 overview: checkout tax, OSS IOSS return preview that ties out. Workflow 2 is the one executives love to talk about and architects quietly fear. The moment your checkout calculates VAT, you're already committing yourself to a future filing position. Under Pillar 3, that filing position often routes through OSS or IOSS, which sounds like simplification until you realize the only way it works is if your transaction data can be aggregated, defended, and reconciled without improvisation. So the workflow starts at the only place that matters: order time. Tax determination at checkout can't be an afterthought anymore because the numbers that hit the customer's screen become the numbers you'll later report and pay. If you true it up later, you've created a drift engine. The customer paid one truth, your ledger posted a second truth, and your OSS return tries to explain a third. That's not compliance, that's arithmetic theater. The pipeline you want is deterministic. Calculate, capture evidence, lock critical rates, and persist the decision. First, calculate the tax based on destination, taxability, and exemptions. Pillar 3 doesn't remove the need to know the correct member state treatment. It just changes where you report it. So you need a consistent way to derive destination, including whatever evidence your business uses to justify that destination. The reason this works is brutal. If you can't prove why you treated a sale as taxable in a specific member state at a specific rate, OSS simply centralizes your inability to explain yourself. Second, Capture evidence as part of the order record, not as a side attachment. At minimum, you need the customer's status signal that drove the logic, the location signal that drove destination, and a timestamp. If B2B is in play, the customer's VAT ID status becomes part of the decision context, not because it's nice to have, but because reverse charge and VAT charging decisions depend on it, and the wrong choice creates mismatches the other side can detect. Third, FX discipline. If you sell cross-border, you will deal with currency conversion, and you will deal with it multiple times, at authorization, at capture, at settlement, and at reporting. If you let each system choose its own rate at its own time, you'll create irreconcilable pennies that turn into unreconcilable totals. So the workflow needs an explicit reporting FX decision, which rate source you used for VAT reporting purposes and which timestamp anchored it. Lock it in the transaction context and do not let it drift just because the payment processor settled later at a different rate. Now you have a transaction record that actually means something. From there, you build a return preview, which is where most organizations find out they never had a data model, just a set of screens. An OSS/IOSS preview is not the final filing, and it's not a quarterly surprise. It's an aggregation view that should be producible on demand, by member state, by VAT rate, by category, and by reporting period, tied back to underlying transaction IDs. If you can't drill from a return line to the list of orders that created it, you don't have a preview, you have an estimate, and the preview must surface exceptions, not hide them. Missing location evidence, unresolved customer status, orders with ambiguous taxability, rate changes applied inconsistently, refunds posted without linked reversal of VAT. These should light up as an exception queue because a preview that looks clean by suppressing bad data is how you end up filing wrong with confidence. Now map this to the Microsoft stack. Dynamics 365 Finance owns the accounting truth, so the postings that represent output VAT by jurisdiction need to reconcile back to the checkout decision record. Power Platform is where you make that practical. Power Automate routes evidence gaps and classification failures to the right owners before period end, and Power BI gives you the operational view. Liabilities by member state, exception aging, and variance between expected VAT from checkout and posted VAT in finance. This is the payoff. Executives get sell everywhere, file once, but only because you engineered calculate once, prove always. Reverse charge expansion, simplification that punishes sloppy customer classification. Reverse charge sounds like mercy. It is not. It's simplification for the state and administrative relief for the supplier, but only if the enterprise can classify customers and establishments correctly, every time, at transaction speed. The webinar research describes the basic mechanism. The non-established supplier invoices without VAT, and the customer accounts for the VAT in their own return. That reduces the need for local VAT registrations. It also moves the failure point upstream into customer data and establishment logic, where most organizations are structurally undisciplined. This is the foundational mistake. Teams treat reverse charge eligible like a tax code you can toggle. In reality, it's a decision outcome derived from facts, where the supplier is established for VAT purposes, where the supply takes place, what the customer is, and whether the customer has a local VAT number that meets the conditions. When those facts are wrong, reverse charge becomes a liability misallocation engine. And under ViDA's direction of travel, more transaction-level reporting and faster visibility, misallocations don't sit quietly until year-end. They surface as mismatches. The research also points to timeline pressure. The reverse charge expansion is phased, with broader expansion by 2028 in the webinar discussion. The exact date matters less than the architectural consequence. You can't bolt this on later because the data you need has to exist before the first invoice is created. Retroactively fixing customer classification after invoices go out is how you manufacture correction traffic. So what actually breaks? Customer VAT ID status is the obvious one, and you already heard why VAT ID validation is evidence, not decoration. But reverse charge adds a sharper edge. It's not enough that a VAT ID exists. It has to be the right VAT ID for the customer in the relevant member state, and it has to be valid at the time of supply. If you store a VAT number in Dynamics and call it done, you'll eventually reverse charge the wrong customer or charge VAT when you shouldn't, and the purchaser side reporting will not match your story. Then there's establishment logic. The webinar frames the reverse charge scenario around a supplier that is not established and a customer that has a local VAT number. That sounds simple until the enterprise has branches, local warehouses, service teams, or other footprints that people casually refer to as just operations. For VAT, those footprints can matter. If the business behaves as established for VAT purposes in a jurisdiction, the reverse charge assumption can collapse. And if your ERP doesn't have a governed way to represent establishment flags and their effect on invoicing, you will encode the wrong policy. This is the part nobody enjoys. Reverse charge requires a deterministic customer classification model. not a free text field, not B2B, B2C as a marketing concept. A model that answers, for each transaction, is the customer a taxable person, which VAT number is in scope, what validations were performed, and what rule path produced the invoicing outcome. In Microsoft terms, the risk pattern is predictable. In Dynamics 365, Finance will happily post an invoice with a reverse charge tax code if you tell it to. That does not mean the decision was correct. It just means the ledger now contains a formal-looking mistake, so you need to enforce the decision before posting, not after. That means the customer record has to carry controlled attributes that feed tax determination. VAT registration status, VAT numbers with jurisdiction context, and whatever flags your tax policy requires. And the transaction has to capture the specific classification used at that moment because customer master data changes over time. If you only keep current state, you lose the ability to prove why you treated an invoice a certain way 6 months ago. Now here's where most people mess up operationally. They let sales create customers. Sales will create customers because the business wants revenue, and revenue doesn't wait for tax hygiene. Under reverse charge expansion, that becomes a structural conflict. So you don't solve it with training, you solve it with gates. Power Automate is the obvious gatekeeper here. When a customer is created or modified, routed through validation steps, require the VAT number in the right format when the scenario demands it, run the validation, and store the result. If the customer is missing the minimum classification, you don't let invoicing proceed on reverse charge eligible flows. You force the organization to finish onboarding, and Power BI becomes the compliance radar. How many invoices used reverse charge? How many lacked a validated VAT number at the time of invoicing? How many required correction? And which business units generate the most classification exceptions? Reverse charge reduces registrations. Fine. But it punishes sloppy customer classification because the system can only be simplified when the facts are enforced. If you don't enforce them, you're not simplifying anything. You're just moving the failure earlier and making it visible faster. Own goods transfers and inventory. The registration pane shifts into reporting discipline. Reverse charge expansion punishes sloppy customer classification. Own goods transfers punish sloppy inventory truth, because once Pillar 3 expands OSS and reduces the need for local VAT registrations, the old pane doesn't disappear, it migrates. Instead of, you must register because stock exists in country, the system moves toward, you must report the movement cleanly with identifiers and reconcile it later. The webinar research frames the direction. Transfers of own goods get pulled into the one-stop shop logic, and the speakers even call out that consignment stock simplifications become unnecessary if stock movements can be reported via OSS in future. That sounds like relief. It is. But it's the kind of relief that comes with a new control surface. Inventory events become tax events. Most enterprises have never treated inventory movements as regulated facts. They treat them as operational noise. Picks, packs, transfers, adjustments, cycle counts, reclassifications, scrapping, returns to vendor, cross-dock movements, and the occasional, we fixed the location code. Warehouses survive on local pragmatism. ERPs survive on delayed reconciliation. The business survives because month-end absorbs the inconsistencies. ViDA removes the hiding place again. If your VAT position depends on where stock is, when it moved, and what it became, then inventory is no longer just supply chain. It's part of the VAT reporting model. And here's the foundational misunderstanding. Teams assume own goods transfers are rare. They are not. Any business with EU warehousing, multi-country fulfillment, repair loops, returns hubs, or redistribution channels generates these movements continuously. They just don't label them as tax events today because the registration model forced them to solve it with local VAT numbers and local compliance processes. Once registration friction reduces, reporting discipline becomes the gate. So what does reporting discipline mean in architectural terms? First, you need event integrity. Every stock movement that matters for VAT must have a stable, unique identity. Movement ID, date, wash time, from location to location, SKU quantity, and valuation context. If you can't uniquely identify the movement, you can't prove it happened once, you can't prevent duplicates in reporting, and you can't link corrections later. And yes, duplicates happen. Warehouses retry integrations, interfaces replay, people repost, systems lag and then catch up. If you don't design idempotency into the movement reporting pipeline, you'll manufacture phantom transfers that look like taxable behavior. Second, you need classification integrity. Not every movement is equal. Some are internal relocations within a country, some are cross-border transfers. Some are returns that unwind previous sales, some are repairs that change the nature of the goods, some are write-offs that should never appear as a transfer, but will if your process model uses the same transaction type for convenience. Convenience is the enemy here, because once you centralize reporting through OSS, the system expects you to know what the movement is, not just that something moved. Third, you need reconciliation integrity. Inventory movements must tie into your sales flows, your invoicing flows, and your cash flows. Not because it's aesthetically pleasing, but because authorities don't accept the warehouse did its thing. They ask why goods appeared in one member state, whether they were subsequently sold there, and how that aligns with reported VAT. This is where enterprises fall apart. Inventory and finance operate as parallel realities. Warehouse truth says stock moved, finance truth says nothing changed until a sale happened. Tax truth eventually tries to reconcile those with local registrations in spreadsheets. Under Pillar 3, you're building a central model, therefore you can't afford parallel realities. Now map this back to the Microsoft stack. Dynamics 365 finance is often where the financial side of inventory lives, but the operational truth frequently lives in warehouse management processes and integrations that finance sees late, summarized, or sanitized. That's survivable under periodic compliance. It is not survivable under transaction-grade reporting. So you need a pipeline where inventory events can be consumed as first-class inputs to tax reporting with the same design laws as invoices, canonical representation, stable identifiers, and a correction trail. Power Platform helps here, but only if you use it for governance, not for duct tape. Power Automate can route inventory exceptions, missing movement fields, invalid location codes, cross-border transfers without required references, or movements posted outside expected timelines. It can enforce that remediation happens at the source, not by editing downstream payloads. And it can ensure every correction is logged with actor, reason, and linkage to the original movement identity. Power BI is where you stop pretending inventory is someone else's problem. You want dashboards that show cross-border movement volume by lane, unmatched movements that don't tie to sales or fulfillment, correction rates, and aging on movement exceptions. If those metrics spike, your registration savings are quietly converting into reporting risk. So yes, Pillar 3 can reduce local registrations driven by stock, but the trade is absolute. Warehouse moves become reportable facts, and facts require discipline. If you can't run inventory like a reliable event stream, you don't get simplification. You get a new category of exception debt, and it will be louder than the old one. Cash flow and VAT. OSS reduces admin, not treasury risk. Pillar 3 sells a simple story. Fewer VAT registrations, fewer local filings, one reporting channel. That story is true. It's also incomplete because VAT isn't just compliance. VAT is cash, and cash doesn't care that your filing process got cleaner. The webinar research states the constraint most finance teams learn the hard way. Local input VAT can't be deducted in the OSS return. Output VAT goes through the OSS mechanism, but input VAT recovery stays on a refund route. Separate process, separate timing, separate risk. So OSS reduces admin, but it does not reduce treasury exposure. It often increases it because you've centralized the output liabilities while leaving the input recovery fragmented and slower. This is the part that breaks budgets. Enterprises model ViDA as a compliance program, then discover a working capital program showed up instead. When you can't net input VAT against output VAT in the same return, you create a timing gap. That gap becomes a cash float you have to fund. And if you operate at scale across multiple member states, that float becomes material whether you like it or not. So the decision point becomes uncomfortable and very practical. Do you keep some local VAT registrations even if you could move transactions into OSS? Because can and should diverge the moment input VAT matters. If you have meaningful local costs, warehousing, returns processing, marketing, subcontractors, repairs, fuel, property costs, then reclaim timing becomes treasury risk. Yes, a refund route exists, but it introduces drag, and drag becomes exposure. The system behaves like this. Compliance simplification pushes you toward OSS, but cash efficiency sometimes pulls you back toward local registration. That isn't indecision, that is architecture meeting finance reality. Now here's the trap most organizations fall into. They treat cash flow as a reporting output. They wait until month end and ask, what's our VAT payable? Under ViDA, that question is too late because transaction-level compliance drives earlier visibility and earlier accountability. If you can see liabilities building daily, then leadership will expect you to forecast them daily. And if your systems can't produce a reliable forecast, finance will build one in spreadsheets. Spreadsheets become the shadow treasury system. Shadow systems become ungoverned. Ungoverned becomes audit pain. So you need treasury forecasting as part of the VAT pipeline, not as a separate finance ritual. What does that mean in practice? First, forecast liabilities by member state, not as one blended number. OSS centralizes filing, but it doesn't change that the liability is still due across jurisdictions. You need to know where the VAT is accumulating, what rate mix is driving it, and what timing profile it follows. Otherwise, you can't plan cash, and you can't explain variance when the payable spikes. Second, model timing, not just totals. VAT exposure isn't just how much, it's when. Under an OSS regime, your payment timing might be predictable, but your cash collection timing is not, especially when sales channels, PSP settlement delays, refunds, and chargebacks distort the cash curve. If you don't model timing, you'll treat VAT like profit and spend it. That mistake never dies. It just gets a new policy memo every year. Third, include FX exposure explicitly. Workflow number 2 already forced FX discipline at transaction time. Treasury needs the same discipline at forecast time. If you forecast VAT using one rate basis but settle using another, your liability moves without any underlying business change. That creates executive confusion, and executives respond to confusion with governance theater. Better to run the numbers on purpose than to explain why they drifted. Now translate this to Microsoft systems, because this is where the architecture either reinforces truth or manufactures illusions. Dynamics 365. Finance holds the ledger truth, VAT liability accounts, receivables, settlements, and cash. But finance only knows what was posted. It doesn't automatically know what's expected based on order flow, and it doesn't automatically know what input VAT recovery timing looks like across refund routes. So you need a VAT cash view that ties three things together: what was collected at checkout or invoicing, what was posted as liability in finance, what was actually paid or recovered and when. Power BI is the obvious cockpit here, not for pretty charts. For operational truth, VAT collected versus VAT reported versus VAT remitted, forecasted payable by period, exposure by member state and currency, variance explanations driven by refunds, chargebacks, and FX changes, and one executive KPI that matters more than anyone admits: days to close the VAT period. If that number grows, your pipeline is decaying. Power Automate is the enforcement layer that keeps Treasury from inheriting chaos. When refund volumes spike, Automate can force tax reversal workflows to complete before payouts release. When refund claims for input VAT stall, Automate can raise aging alerts and require evidence pack completeness. When a business unit starts creating off-ledger adjustments, Automate can route it into a controlled correction path instead of letting it leak into "we'll reconcile it later." OSS reduces admin, fine. But it does not reduce treasury risk, it exposes it. And once VAT becomes observable daily, cash risk becomes observable daily too, whether you engineered for that reality or just hoped it would stay invisible. Workflow 3 overview. PSP settlement. Checkout, DRR, bank. Here's the workflow that exposes whether you actually run a controlled VAT pipeline or whether you just post accounting entries and hope reconciliation sorts itself out. PSP settlement, because payment service providers don't settle like your ERP thinks they do. They settle net, they batch, they deduct fees, they hold reserves, they replay chargebacks weeks later, and they do all of that while your tax reporting story is trying to be transaction perfect. So workflow number 3 is the 3-way, sometimes 4-way, reconciliation loop. Checkout says what you charged. DRR says what you reported. The PSP says what you actually received. The bank says what cash really landed. If those don't align, your VAT payable number becomes a belief system. And under ViDA, belief systems get audited. Start with the common failure mode. The business trusts the order system more than the cash system. The order system says 120 collected, 20 body VAT. But the PSP settles 114.37 because it deducted fees, converted currency, netted refunds, and included transactions from other days in the same payout. Finance then posts the payout as revenue and clears receivables, and VAT sits in the ledger like it's clean. It isn't. The system did not collect what you think it collected. And if VAT is included in that gross, the difference isn't just a variance. It's a question: where did the VAT go? So the objective of workflow number 3 is narrow and brutal. Prove that tax collected equals tax reported equals tax remitted. Not conceptually, practically, with evidence. That means you need a canonical settlement model, one that can represent the PSP payout as a structured object: payout ID, payout date, currency, gross amounts, fees, adjustments, refunds, chargebacks, reserves, and net amount. Then you need to map that payout object back to the underlying transactions at checkout level. This is where most people mess up. They try to reconcile at the journal level, one payout journal to one bank statement line. That's not reconciliation, that's matching two summaries and calling it done. Under ViDA, summaries are where fraud and errors hide, which is why the system is shifting toward transaction visibility in the first place. So you reconcile at transaction lineage. Check out transaction ID, payment intent, charge ID, PSP payout line, bank statement line. If you can't traverse that chain, you can't explain variances. And if you can't explain variances, you can't prove your VAT position. Now add DRR to the loop. DRR is not cash aware, DRR is invoice aware. It knows what was invoiced and reported, and it can acknowledge or reject, but it doesn't know that the PSP withheld a portion or that a chargeback landed later. So your architecture needs to link DRR identifiers to the same transaction identity used in payments, so that when cash deviates from expectation, you can determine whether the tax story needs a correction event. That's the hidden pressure. Payment events create tax correction obligations. Refunds and chargebacks aren't just revenue reversals. They are VAT reversals when VAT was collected. If your payment pipeline can process refunds without triggering the tax correction trail, you've built a drift machine that leaks VAT truth slowly, then forces a painful cleanup later. So here's the VAT wallet discipline. Treat VAT as ring-fenced cash in your ledger and treasury view. Not because the bank account is physically separate, but because the system must behave as if it is. Every day, you should be able to say, this is VAT collected, this is VAT refunded, this is VAT still held, and this is VAT due to be remitted. If you can't compute that daily, you will eventually spend VAT cash on operating cash. Then filing day becomes a funding event. Auditors love that story. In Microsoft terms, Dynamics 365 Finance holds the accounting truth, but it needs transaction-grade references to do it. Your settlement import can't be a blob. It needs structured payout lines tied back to orders and invoices. Power Automate is what roots the ugly cases. Unmatched payout lines, missing payment IDs, refunds without linked credit notes, chargebacks without correction trails. And Power BI is how you see whether the machine is healthy, reconciliation completeness, unmatched aging, variances by PSP and country, and the delta between VAT expected from checkout and VAT realized from settlements. This is the difference between compliance as paperwork and compliance as a system. One hides drift until month end, the other makes drift visible daily, so you can kill it before it becomes policy. Microsoft architecture positioning, record orchestration insight. At this point, people usually ask the wrong question. Which Microsoft product does ViDA? None of them do, because ViDA isn't an app. It's a control plane expectation imposed on your transaction pipeline. Microsoft gives you components. You still have to build the machine that behaves deterministically when regulators stop tolerating drift. So the positioning has to be explicit, or you end up with architecture by accident. Dynamics posts something, Power Automate patches something, Power BI reports something, and nobody can explain why the numbers don't tie. Here's the framing that holds up under audit pressure: record, orchestration, insight. And each role has hard boundaries. Dynamics 365. Finance is the system of record. That means it owns the accounting truth, posted invoices, tax calculation outcomes that you stand behind, subledger detail, and the final liability numbers you'll reconcile to filing and payment. Finance is where you stop debating and start committing. Once the transaction posts, it becomes your official position. If that position is wrong, the correction trail needs to be deliberate, linked, and explainable. So you don't use finance as a scratchpad for "we'll fix it later." Under ViDA, later is detectable and month-end cleanup becomes an anti-pattern. But finance also shouldn't be forced to become your integration hub or your evidence archive. If you stuff every payload, acknowledgement, validation response, and proof artifact into ERP tables, you'll create a data model that nobody can govern, and a performance problem you'll call complexity. It isn't complexity, it's a design omission. Finance records the commercial and tax truth. It references evidence by stable identifiers. It doesn't try to be the evidence warehouse. Power Platform is the orchestration layer. And no, that doesn't mean automation for convenience. It means controlled exception handling, routing, gating, and state management, where the business process intersects with compliance deadlines. Power Automate is where you turn policy into enforcement without rewriting your ERP. When an E-invoice gets rejected by a rail, Automate routes the exception to the owner, captures the reason code, triggers remediation tasks, and controls resubmission so you don't spray duplicates. When a supplier onboarding flow is missing VAT status, Automate blocks the path that would create non-compliant transactions. When a refund occurs, Automate triggers the correction workflow, so tax reversals stay linked to the original decision and identifiers. This is where most enterprises fail. They treat exceptions as rare. Under transaction controls, exceptions are continuous, and the platform that can't route them becomes the bottleneck that breaks deadlines. So Power Automate is your exception conveyor belt. Power Apps is your controlled input surface when humans must touch the system. Seller onboarding, VAT number capture, evidence attachments, correction reason codes, approvals for reissuance. If a human decision matters for compliance, it needs a governed UI that forces completeness and leaves a trail. Email threads don't count. Dataverse, in this context, becomes the operational state store, the place where you can track transaction compliance states without mutating the accounting record in finance. Posted is posted. Orchestration state can evolve. Power BI is the insight layer, not dashboards as decoration. Dashboards as early warning systems. In a ViDA world, the question isn't, are we compliant this quarter? It's, are we compliant today and where will it break next? Power BI answers that by making the pipeline observable. Success rates, exception aging, reconciliation completeness, and the deltas between what checkout says, what finance posted, what DRR acknowledged, and what cash actually settled. And that visibility is not optional, because the organization will otherwise invent visibility in spreadsheets. Spreadsheets are how architecture degrades quietly. Now, Azure sits underneath all of this as the backbone, not the star. You need reliable integration patterns, event-driven triggers, durable storage of immutable payloads, queues for retry and replay, and access control that treats compliance artifacts as sensitive data. You need idempotency keys so resubmissions don't create duplicates. You need retention that survives application upgrades and vendor changes. That's what Azure is for, scale and resilience. but you keep it implicit in the narrative because the audience isn't trying to become a cloud engineer. They're trying to survive a control plane shift without rebuilding their entire stack. So the Microsoft message is simple and blunt. Dynamics 365 Finance, record the truth you'll defend. Power Platform. Orchestrate the reality you can't avoid. Exceptions, corrections, and evidence. Power BI. Observe drift before regulators do. Azure. Make the whole thing durable enough that it doesn't collapse the first time a rail goes down. If you remember nothing else, remember this. ViDA doesn't require more systems. It requires clearer system roles. And those roles are what prevents conditional chaos from becoming your operating model. Governance, controls, evidence, and correction trails. Governance is where most ViDA programs go to die quietly. Not because controls are hard. Controls are easy to describe. Governance fails because people treat it like documentation, when it's actually runtime behavior, what the system prevents, what it detects, what it records, and what it allows to be corrected without turning into fiction. Under transaction speed reporting, we have a policy is meaningless. Only enforced intent matters. So governance starts with a clean separation. Preventive controls, detective controls, and the correction trail that binds them. If you blend those into one vague compliance process, you'll end up with conditional chaos. Exceptions handled inconsistently, corrections made without lineage, and evidence scattered across email and screenshots like it's still 2005. Preventive controls are the ones that stop bad data from becoming legal truth. This isn't about perfection, it's about blocking the predictable failures that create downstream rejections, missing VAT IDs where required, invalid address structures, missing mandatory invoice fields, broken sequencing, and timing breaches against the 10-day issuance and reporting expectations described in the webinar. The trick is where you enforce. If you enforce preventive controls after posting, you're doing governance theater. The ledger already contains a committed position. Under ViDA, prevention has to happen before the moment the invoice becomes an outbound regulated object, whether that object is issued by Dynamics 365 Finance, by a platform system, or by an invoicing provider. So, prevention looks like this in practice. Validate the master data inputs, validate the transaction object against the EN 60931 semantic requirements you're mapping to, validate the numbering and linkage rules for credit notes, and validate that the decision evidence exists for the scenario. Then allow posting and submission. Otherwise, route to exception handling with a reason code that is machine readable, not a human rant. Detective controls are different. They assume bad things will happen anyway, because they will, and they exist to find drift early. Drift is what kills you, because drift turns into a backlog, and the backlog turns into manual cleanups, and manual cleanups create undocumented decisions. Detective controls are thresholds and reconciliations. Invoice success rates to the rail, rejection categories, exception aging, missing acknowledgements, mismatches between what was invoiced and what was reported, and mismatches between what was collected and what was posted as VAT liability. The thing most people miss is that detective controls must be owned. A dashboard that nobody is measured against is just wallpaper. Under ViDA, you want operational owners for specific signals. Rejection rate over X, exceptions older than Y days, unmatched settlements over Z, missing evidence count. And you want escalation rules that don't rely on heroics. Now the core, the evidence pack. People hear evidence and think attachments. That's amateur hour. Evidence in a transaction control model is structured, linkable, and replayable. For each regulated transaction, you should be able to produce, without debate, an evidence pack that contains the invoice payload as submitted in the structured format you used, the DRR submission metadata, timestamps, message IDs, and the acknowledgement or rejection response. The VAT ID proof where applicable, including the validation outcome and the date it was obtained. The location evidence used for place of supply decisions when destination matters. The FX source and timestamp if currency conversion influenced reporting values. And the linkage between original invoices and any corrections, credit notes, amendments, resubmissions, and their identifiers. That pack doesn't have to be one physical file, but it must behave like one. Stable identifiers, retention controls, and the ability to reconstruct the decision without trusting live system state, because live state lies. It changes. Correction trails are where enterprises either mature or collapse. In the old world, corrections were period level. Adjust in the next return, maybe issue a credit note and hope it ties out. The webinar makes the shift clear. Reporting becomes transaction level and the time window shrinks. So corrections become transaction-linked amendments with lineage. That means you need versioning discipline. Not update the invoice record. Create a new correction object that references the original, states the reason, preserves the original payload, and generates the new payload with a new submission. Every correction should answer 3 questions. What changed, why it changed, and which regulated objects were affected. If you can't answer those instantly, you don't have a correction trail, You have edits, and edits are not defensible. Now map this governance model onto the Microsoft stack without turning it into a compliance art project. Dynamics 365 Finance holds the posted truth and must preserve the integrity of posted records. Power Platform governs the human touchpoints, the approvals, reason codes, and evidence capture that corrections require. Power Automate enforces escalation and routing for both preventive failures and detective signals. Power BI makes governance observable, not just what happened, but where the control plane is eroding. Governance is not a binder, it is enforced intent, preserved evidence, and correction lineage that survives audits, outages, and organizational amnesia. Continuity planning, lawful degraded modes, replay, and idempotency. Continuity planning is the part everybody claims they'll do later, right after they finish the fun parts like mapping and dashboards. They are wrong, because ViDA doesn't just tighten deadlines, it removes tolerance for ambiguity, and outages manufacture ambiguity at scale. The system will fail on schedule. Access points go down, national nodes time out, certificates expire, queues back up, ERP posting lags, and payment processors deliver settlements whenever they feel like it. None of that is new. What's new is that your old workaround, delay and manual cleanup, stops working when reporting expectations converge toward near real-time and transaction-level comparability. So continuity under ViDA is not high availability. It's lawful degraded modes. A degraded mode is what the business does when the rail is down, the submission can't happen, or an acknowledgement doesn't return. And lawful matters because a fallback that breaks chain of custody is just fraud with better intentions. There are 4 failure modes you design for because they are inevitable. First, the transport rail fails. Your PEPAL access point is unreachable, or a clearance system like Italy's archetype is not responding. In that moment, you don't need heroics. You need a controlled queue that can hold submissions without mutating them. Second, the national node fails in a partial way. You can submit, but you don't get acknowledgements. That creates the most dangerous state. You can't tell if the transaction was accepted, rejected, or duplicated. If you respond by resubmitting blindly, you create duplicate reporting. If you respond by waiting indefinitely, you create deadline breaches. Third, your ERP posting lags. The invoice exists in commerce or billing, but finance hasn't posted it yet, or posting failed. If you submit to DRR before finance is the truth, you'll report something you may later reverse or change. If you wait for finance, but finance is late, you'll miss the reporting window. That is where architectural discipline matters. The invoice becomes reportable only when it reaches a specific state you can defend. Fourth, settlement drift. PSP payouts include refunds and chargebacks that arrive after the original reporting. If you don't design for those late events, your truth diverges quietly until you can't reconcile. Now, the engineering discipline that makes all of this survivable is simple. Capture immutable payloads and replay them safely. Immutable means the payload you intend to report gets stored exactly as generated with a stable identifier before you attempt submission. Not we can regenerate it from the database. Regeneration depends on live state, and live state changes, prices get recalculated, addresses get corrected, VAT IDs get updated. If you rely on regeneration, you'll replay a different invoice than the one you originally attempted to submit. So you store the submission artifact as an object, payload, metadata, timestamps, and the identity keys that link it back to the transaction, the invoice, and the evidence bundle. Then you submit. If submission fails, you don't rebuild, you replay. Replay requires idempotency because regulators don't enjoy duplicates, and neither do auditors. Idempotency means you can send the same submission again without creating a second logical transaction. In practical terms, you need deterministic idempotent keys. A unique submission ID tied to the invoice identity and version. Same invoice version, same key. Correction version, new key. If the rail accepts an idempotency key, you use it. If the rail doesn't, you simulate the behavior by tracking your own submission attempts and never emitting duplicates unless you can prove the original attempt did not land. That distinction matters because at least once delivery is how integration works. Exactly once business meaning is what you have to engineer. And you also need a lawful offline posture, even if the law varies. Some regimes will allow delayed submission under defined outage conditions. Some will not. The research makes clear that the technical specification details will evolve over time and member states retain choices, so you do not hardcode offline allowed. You design the pipeline so that offline operation still preserves evidence, the payload, the failure reason, the timestamps, and the retry sequence. That is what makes it defensible later. You can show what you tried to do, when you tried, why it failed, and exactly what you sent when the rail came back. Now map continuity into the Microsoft ecosystem without turning it into an infrastructure lecture. Dynamics 365. Finance stays clean. Posted truth, stable identifiers, no panic edits. Power Platform governs state transitions and exceptions. When an invoice is ready to submit, when it is submitted, when it is awaiting acknowledgement, and when it becomes exception-owned. Power Automate routes those exceptions and blocks downstream actions like payouts when the compliance state is unresolved. And your backbone, Azure or any durable integration layer, stores immutable payloads, runs queues, and supports replay with idempotent keys. Then you do chaos drills. Not because it's trendy, but because the first time you test replay cannot be when the rail is down and the CFO is asking why VAT reporting stopped. You prove failover, replay, and state recovery without breaking chain of custody. Because under ViDA, continuity is not uptime. Continuity is being able to prove what happened when the system didn't. Country anchors Italy SDI versus Poland, KSEF versus Nordics PEPOL. If ViDA still feels abstract, these three country anchors fix that. They show the same destination, transaction controls, but through different rails and different cultural assumptions about trust. Italy is the clearance archetype. Poland is the schema and state machine archetype. The Nordics are the interoperability archetype. And you don't get to choose which one you prefer. You get to operate across all of them while trying to pretend you have one invoicing solution. Start with Italy's SDI model as the mental baseline for clearance. The defining behavior is simple. The invoice isn't really an invoice until the system says it is. That single fact rewires your process design because your internal posting, your customer communication, and your tax reporting all become dependent on acknowledgements and status. That distinction matters. In a clearance world, you architect for sequencing discipline. You architect for deterministic numbering. You architect for explicit acceptance and rejection states. And you architect for the reality that sent is not a terminal state. It's a request for permission. So the Microsoft implication is not, we can output XML. It's that your Dynamics 365 Finance invoice lifecycle must map to a regulated lifecycle. If SDI rejects, you need a correction path that preserves lineage. If SDI accepts, you need to persist the acknowledgement identifiers as part of the evidence pack. If you can't do that, you can't prove the invoice existed in the form the authority considers valid. Now, Poland's KSEF model sits in a similar family, but the failure mode is different. Poland is where teams learn that schema versioning is not a technical detail, it is the operating model. Because when the platform enforces a schema, your adapters rot unless you govern them like code. Your mapping layer becomes a product that needs releases, testing, and change control. Otherwise, the first schema update turns into a production incident with a tax deadline attached. This is where most people mess up. They treat country adapters as integration projects, then they walk away. Under a KSF-style system, walking away is how you create deferred outages. The system will accept your payload until the day it doesn't, and then your compliance pipeline becomes a queue of rejected invoices with no rapid remediation path. So architecturally, Poland forces a normalization layer with explicit version management. Canonical invoice in your domain, deterministic transforms to the target schema, validation before submission, and a release process that treats schema changes like breaking API changes. Dynamics holds the posting truth. Fine. But you can't let finance become the place where transforms happen ad hoc. Put the transforms in a governed layer and make the output artifacts immutable. Then Power Automate routes rejections with reason codes and forces the fix upstream, not in the payload after the fact. Now the Nordics and the Netherlands, often used as a PEPOL-heavy reference, show the other rail, interoperability. PEPOL is not a tax authority platform in the clearance sense. It's a network pattern, access points, standardized documents, and a delivery mechanism that scales because it doesn't centralize permission. The benefit is obvious: reuse. One access point strategy can serve many counterparties. The network effect reduces bespoke integrations. Enterprises like it because it feels like messaging, not control. But interoperability still enforces discipline, just in a quieter way. You still need E-16931 semantics. You still need code list hygiene. You still need predictable identifiers. And you still need to handle delivery and validation failures because it should work is not an engineering strategy. So the PEPOL lesson is different. The rail doesn't impose a single state machine, therefore you must impose your own. You track sent, delivered, acknowledged if available, and failed. You build your own evidence pack from message metadata, access point logs, and your own stored payloads. And you accept that different member states may layer additional requirements over time because interoperability is not the same thing as uniformity. Now pull these three anchors into one enterprise conclusion. Clearance teaches you that acceptance is a system event, not a human belief. KSEF-style schema enforcement teaches you that adapters rot unless you manage them as software products. PEPOL teaches you that decentralization still requires deterministic internal state because the network won't save you from your own ambiguity. So the strategy is not pick the right country solution. The strategy is one normalization layer with adapters and one compliance state model that your business actually uses. That is how you avoid country-specific spaghetti. And that's why the next section isn't about theory. It's the playbook. Start small, build the rails, then scale. Implementation playbook. Start small, build the rails, then scale. This is the part everyone asks for, because after 20 slides of control plane shift, they want a checklist. They won't get a checklist. Checklists rot. What they can get is a playbook that survives entropy. Start small, build the rails, then scale. Because ViDA doesn't reward ambition, it rewards repeatability. Start with an impact study, but do it like an engineer, not like a tax memo. The research advice is clear. Map transactions, understand which flows are in scope, and translate obligations into system requirements. So the output you want is not a PowerPoint, it's a transaction inventory. Which systems create invoices, which systems calculate tax, which systems hold customer and product data, which systems touch payments, and which systems store evidence today, if any. Then you mark the failure points, where data gets rekeyed, where fields are optional, where identifiers change, where someone fixes it later is the operating model. That becomes your backlog, not implement ViDA. Implement the parts of your pipeline that currently rely on delay and goodwill. Now pick one thin slice and ship it. The foundational mistake is trying to solve all countries, all transaction types, and all rails in one go. That produces an integration hairball and a governance vacuum. Instead, choose a single high-volume flow you can control, end-to-end, one entity, one channel, one or two countries, and build the ViDA rails around it. Pillar 1 is the right place to start because it defines the runtime behavior. E-invoicing and digital reporting. So build the E-invoice and DRR pipeline first, even if the legal deadline feels distant. It's the forcing function that fixes your data model and your exception lifecycle. Your deliverables are boring, and that's the point. A canonical invoice object mapped to EN16931 semantics in your domain model. A submission service that emits immutable payloads, tracks state, and stores acknowledgements. An exception queue that can be owned, aged, and cleared. And an evidence pack pattern that you can reproduce per transaction without debate. Do not start with a country adapter. Start with the normalization layer that makes country adapters replaceable. Once that rail exists, add the operational surface area that keeps it from collapsing. Master data controls that validate VAT IDs and required codes before posting. Numbering and linkage rules for credit notes and corrections. And dashboards that expose failure as early as possible, rejection categories, exception aging, and success rate. At this stage, Power Platform earns its keep. Power Automate routes exceptions and enforces gating. Power BI makes the pipeline observable. And Dynamics 365 Finance stays what it should be, the system of record that posts the truth you'll defend. Now you layer Pillar 3 capabilities because OSS and reverse charge decisions depend on the same discipline. This is where you build workflow number 2 as a product. Checkout decision capture, evidence capture, FX discipline, and an OSS return preview that ties back to transaction IDs. The preview is not a quarterly report. It is a daily visibility artifact. If it can't run daily, it isn't real. Then you implement reverse charge decisioning as a governed model, not as a tax code toggle. Customer classification and establishment flags become controlled attributes with validation and history. The system must be able to answer why later, not just what today. Inventory and own goods transfers join this phase if they apply because they're part of the same reporting truth. Movements as events with identities, classifications, and reconciliation paths. Only after Pillar 1 and Pillar 3 rails behave do you touch Pillar 2, and only if your business lives there. If you are a platform in short-term accommodation or passenger transport, you build deeming logic as product design. Onboarding that captures VAT status evidence, pricing that handles VAT inclusive display correctly, and payout statements that reconcile gross, fees, VAT retained, and VAT remitted. If you're not in that world, you don't burn program time pretending you are. Now here's the scaling rule that makes or breaks this. Every new country, rail, or transaction type must plug into the same normalization layer, the same evidence pack model, and the same exception lifecycle. If a new requirement forces you to fork the model, that fork becomes permanent, and permanent forks become compliance debt. So you scale by adding adapters, not by rewriting behavior. Italy-style clearance, new adapter, same canonical invoice, same state machine, different acknowledgements. Poland-style schema enforcement, new adapter, version transforms, same orchestration, stricter pre-validation. Nordic-style PayPal interoperability, same semantic contract, different transport, same evidence discipline. And you keep running continuity drills, rail down, acknowledgement missing, replay required, correction path invoked. Because the first time you discover your idempotency story is broken cannot be during a reporting window. Start small, build the rails, scale with adapters. That's the only way this turns into architecture instead of patchwork. The uncomfortable truth. ViDA turns tax into an always-on system. Now the uncomfortable truth. ViDA doesn't digitize VAT. It operationalizes VAT. That sounds like the same thing until you live through it. Digitization is when you take the old process and run it faster. Operationalization is when the process stops being a calendar event and becomes a continuous system behavior. And ViDA is built to eliminate your favorite feature of periodic compliance, the month-end hiding place. Most organizations believe they can file their way out of bad transactional data. They are wrong. Under a transaction control model, the filing is no longer the first time the numbers matter. The numbers matter at the moment they are created, at checkout, at invoice issue, at submission, at settlement, and at correction. And the system remembers each of those moments with identifiers and timestamps. That distinction matters because it converts we'll reconcile later into we can't explain it now. This is why the just add e-invoicing mindset is a program killer. Not because XML is hard, but because e-invoicing is only the data contract. The real change is observability, the authority's ability to compare supplier and purchaser, to correlate invoices and payments, and to see patterns faster than your quarterly close process. So the enemy isn't non-compliance, the enemy is drift. Missing policies create obvious gaps. Drifting policies create ambiguity, and ambiguity is where exception debt accumulates. Every time someone makes a local workaround, an override tax code, a manual credit note, an adjustment journal, a reissued invoice without linkage, you convert a deterministic security model into a probabilistic one. Not because you love chaos, because the system let you. Over time, those exceptions become normal. Then they become invisible. Then the business depends on them. That is architectural erosion. ViDA rewards architecture because architecture is the only thing that scales intent. You can't train 5,000 users into consistent behavior under a 10-day window with real-time submission pressure. You enforce your assumptions at scale, or you don't have assumptions. You have hopes, and the system will not honor your hopes. So what does always-on tax mean for an enterprise running Dynamics 365 Finance and the Power Platform? It means your tax position becomes a pipeline with state, ownership, and telemetry. Not a team, not a spreadsheet, a pipeline. Calculate once. Capture evidence once, report once, reconcile continuously, correct with lineage, prove on demand. If any one of those stages runs on a different truth, the pipeline breaks. This is where systems thinking replaces clerical work. Finance and tax stop living at month end. They start living in exception queues and reconciliation deltas. The business stops asking, did we file? And starts asking, are we green today? And that's a harder question because green today is a runtime property, not a checkbox. Now here's the part people don't expect. Early movers don't just get compliance, they get operational advantages. Because when you build transaction-grade rails, you also build cleaner master data, faster close, fewer disputes, and more predictable cash, not as a motivational promise, as a mechanical consequence. A deterministic pipeline reduces rework, therefore it compresses cycle time. It also makes blame harder because the data shows exactly where the pipeline broke. Organizations hate that at first, then they realize it's cheaper than guessing. But early mover payoff only happens if you treat ViDA as a product. A product has a backlog, a product has releases, a product has monitoring, a product has incident response, and a product has owners. A project has a go-live date and a committee. ViDA eats committees. Because once the rules are live, you don't get to pause the pipeline. You don't get to negotiate with an outage. You don't get to ask the authority for one more month because your adapter broke. The system just keeps asking for data, therefore you keep producing data, therefore you must keep the machine healthy. That's why the common data model matters. If you build one canonical transaction representation, one evidence pack pattern, and one exception lifecycle, you can change rails without changing the business. You can add countries without forking the logic. You can survive schema changes without panic. You can replay submissions without duplicating legal truth. You can reconcile cash without inventing a second ledger. If you don't, your future is permanent exception debt. And permanent exception debt is expensive in the only currencies leadership understands: cash, time, and audit pain. So yes, ViDA is about VAT, but architecturally it is something else. The redesign of European trade as a continuously measured, continuously compared, continuously enforced data system. You can build a pipeline that behaves deterministically under that pressure. Or you can keep patching and watch your compliance posture turn into conditional chaos. Treat ViDA as a product, not a project. ViDA's key takeaway is simple. Build a transaction-grade pipeline, calculate, invoice and report, reconcile, file, and prove, because the month-end hiding place is gone. If you want the practical build, watch the next episode on Workflow 1, Dynamics 365, Finance to E-invoice to DRR with the evidence pack and exception queue that makes it survivable. Subscribe if you want the rest of the mini-series because this control plane isn't waiting for your roadmap.